Okay. Are we live, Saul? Not yet? Okay, great. Ophir, can you please grab me a glass of water? Is it okay to ask? Wow, that was fast. You know what, I got one right here. Thanks so much. I had to do it. Alrighty, guys. So, welcome to the Trading Strategy Marathon. I am Michael Katz. I'll be your host for today, and later on you will see me presenting my own unique strategy. Just before we'll dive in, let me give you a quick introduction or an overview of what to expect in this amazing live event that we have prepared for you. Let me see that everyone can hear me back home, and we will get this party started. Do we have the audience? Okay, great. So in the next 6 hours, 6 expert traders, including myself, will present our own professional way to trade in today's market. Now, I gotta tell you, it's gonna be an amazing event, and I can guarantee that it will boost your trading for 2023. Now, it's not gonna be just an ordinary one or a webinar. In fact, the guys here are so pumped that we have created a raffle for each presentation. So at the end of every lesson, the presenter will ask you a question regarding the topic he just covered, and if you get the correct answer, you will join the raffle and potentially win unbelievable prizes. 6 tickets to our live event in the upcoming session or amazing event in London in this summer, and also 12 evaluation trading accounts so you can trade our own capital instead of risking your own. So guys, make sure you pay attention, shut down your Facebook, Instagram, Discord, and your trading platform, and let's get this party started. Alrighty, so here are the topics for today's event. The first guy to show, straight from Australia, Jordon, will talk about to trade the market without using the trend. That's gonna be an amazing presentation. The second guy, Ruben, is our French guy. He will show you how to use volatility to find the right edge in the market. Then Saul will take the famous story of David and Goliath and reflect it on the markets today with his own unique strategy. Our Mother Teresa, Yaniv, here in the office, will show you how to use his top-notch trading strategy for EMAs. Then myself, I will show you the way of picking the right asset to buy the dip with. And lastly, the guy that looks like Bruce Willis with 20 years of experience will share his supply and demand masterpiece. So without further ado, let me bring out the first guy, Jordon. I'll take the headset to talk to him. Alrighty.
I can. How you
How's
doing,
it
Michael?
going? Wonderful.
Yeah,
Great.
well.
Thanks for coming in. It's good that you're alive. I heard that you had an accident with a shark yesterday in the sea in Australia.
That's right. That's just a usual endeavor for an Australian, going down to the beach and having the sharks prominent. The point you have to get out the water, but we're used to it by now, so it's nothing too much to worry about.
Just another day in the neighborhood, right?
Yeah. Exactly right. You're looking very dapper, if I say so myself, Michael. I like the jacket you're wearing today.
Thanks so much, buddy. Thanks so much. So take it away, buddy. And later on, after that, we will answer, of course, the questions that you guys at home will drop in the chat box and the riddle that Jordon prepared for you. So enjoy.
Fantastic. Thank you very much. All right, guys. Well, let's take a breath. We've got a fair bit to get through today, not only from myself, but from the whole lineup that you just seen that Michael's done a great job of introducing everyone. It'll give us a bit of stick throughout the day, so don't be afraid to give him some back. He's got some good head on his shoulders, so he's quite witty with it. But today, look, it's something that's been highly requested for you guys that know me. I've been live in front of a lot of you quite often. It's understanding how I go about trading the market. Now, I do have the chat up on my screen. I can see how excited some of you are. I did see someone earlier said they've got wine and chips at the ready to fire their boss. I love the energy that's coming out of the chat room. Keep that coming in, guys. Any big questions, any in-depth questions you do have for me and anyone else for that matter throughout today's webinar, just send them in. Michael will give us a rundown and a hard quiz towards the end of our webinars, answering all of your questions, and we can have an open discussion about that. So if you do have any questions for me throughout today, we're very open-minded, we're very open, ask away, and we'll address those towards the end of the webinar. Excuse me. It is a little bit later on here. As you can see, it is dark where I am compared to everyone in the office. I am coming from the other side of the world, but I do appreciate the opportunity, which means we can have an edge here because I can tell you how I trade the APAC sessions over here from Melbourne, Australia. So without further ado, I think the best thing to do is just to get into it. So let's have a look, shall we? Patrick, just to confirm, everyone can hear me. I see there's a bit of an error coming through there, but let's have a look. No, we're talking about sharks, so it can't work. Oh, Raymond's calling me out for being rugby. Okay, let's not get distracted. We're going to talk about when the odds are in your favor. How do we fade fair value? And this is a strategy which I've traded for a little over 12 months now. It's a strategy that I've really built around my personality, really extended and expanded my own skill set into building this strategy. And it's something that has developed and provided me my most profit over the past 12 months. So I have the highest success rate and the highest risk to reward ratio based on this strategy, which is why I'm delivering it here for you guys today. As soon as I was asked to do this webinar, it was a no-brainer on which strategy I was going to provide you guys with, because it is the clear winner for me of recent. So it's quite complex. I'm going to break it down into some simple steps that you can follow every day. And then I'll go through the more complexity of the strategy and really the edge that it can provide later on as we start to unfold through some examples. But in order to get a grasp of everything that's going on, I think it's fair to say you need to understand who I am. My name is Jordon Mellor, and I am the Chief of Content at Trade Delicious. I won't talk too much into Trade Delicious because I'll do that towards the end of the webinar. If you have seen Trade Delicious or you have seen my content before, hello to your beautiful face. Thanks for coming back and tuning in. I hope you're excited for this, but I will talk a little bit more on Trade Delicious a little bit later as well. I'm a senior analyst at the 5%ers and Trade the Pool. I've been here for a little over a year now, and I don't think the team's quite sick of me. I'll give it another year. Maybe they'll get a bit sick of me, but I think that's what helps with being the other side of the world. Nah, they're lovely people. We do get along. I've been a day trader for about 7 years now. Not profitable for 7 years, a day trader for 7 years. Very important to note. It does take a little while to get that learning curve, but I've been looking at different strategies, different markets, and I've been trading for quite some time. I hit profitability about 3.5 years into my trading journey, and I've been profitable ever since, funded at firms. That's how I met everyone at the 5ers and end up sitting in front of you here today as well. I am a big sports enthusiast. Any type of sport, you name it, I'll know a fair bit about it. I'll have a team and we will be able to talk about it over a couple of beers at a pub. There's no joke about that, as well as golf. Okay. I'm a big fan of golf. I'm not very good, but I am a big fan of golf. So if there's any golfers out there, I'm the guy. Let's have a chat about how I can always triple bogey on a par 3. But no, all sports. I remember a couple episodes. You see, I'm a host of Traders of Money, which is a podcast over on Trade Delicious. A couple episodes ago, I sat down with the great psychological coach Mandy Rafsanjani, and we actually spoke about the similarities between golf and trading. And I recommend going to check that out because it's quite remarkable on how similar playing golf, something so simple, something that people find so boring, is so similar to trading. Just your tools and the field you're playing on. Same thing in trading. But that's a little bit about me. I'm quite relaxed. I'm very open. I've got nothing to hide. We're all like this at the firm. We're very open in who we are, what we achieve, and what we do, which is why we're really excited to bring this. I know my energy is a little bit lower. It is almost 10 o'clock at night, and I have, as you mentioned, Michael mentioned, been at the beach the last couple of days, so the energy does drain a little bit. But I'm going to psych it back up, get back on your levels, and we're going to dive into my strategy. So I think it's really important to start us off going over a preview. Get an understanding of, Jordon, what is it you do? Now, you can see by the header, I won't say it just in case YouTube won't be very happy with us, but we're going against the trend, right? I'm a contrarian trader. I like to go against the trend, and finding the markets and the assets to do this in is very important, because we can't just short when the market goes up or buy when the market goes down, right? We need a strategy. We need a proven track record to back up the investment decisions that we're making. So today I'm going to run you through exactly what my step-to-step process is in achieving that. First thing is, who does this strategy suit? Who's it for? And where are you going to be able to draw the most profit from? To put it simply, this strategy best suits day traders, okay? This is people who are going to be able to sit in front of the screen for 6 to 7 hours a day, depending on the session that they're trading, have the time to sit there, manage their positions, hold on to positions for a little bit longer, and be done by the end of the day. Cut the trades, cut the loss, cut the win, whatever it might be, call it a day, go to sleep, get up tomorrow, and come back in. Okay, so this really suits day traders. If you're a swing trader or a tiny scalper, it might not be the strategy for you. However, you may be able to depict some very important aspects of my strategy to apply to yours in help you giving an edge. So this strategy is designed for day traders. What assets or asset classes do we really thrive in? There's two main ones, and the two main ones we are going to run through today. The reason these are my main ones is because over the past 12 months, these are the two that have provided me the most profitability. Okay, so I want to give you guys the insights into what's working with this strategy right now. And if we have time, this strategy produced a trade earlier today. Right now, obviously it's 10 p.m. my time, so earlier today is is a while ago. But yesterday for you guys, it did actually play out earlier today. So if we get time, I'm going to show you that after the webinar. This suits indices, okay? Indices like the Nikkei, your indices like the XJO or the Oz 200. You can trade it in the S&P 500. However, I don't love the whole complexity of that asset compared to trading it on things like the DAX. For the sake of today, we're going to be focusing on the XJO, and we're also going to be looking at low to medium liquidity FX pairs. Okay, so what I mean by that is necessarily to try to find an asset during a certain time of the day which doesn't produce huge moves, but it can produce huge moves. So for me, I'm based in Melbourne, Australia. The Asian session is where I thrive. So when I look into the Asian session, as most of you will already know, if you're already in FX trading, you get lower liquidity, okay? Lower volume. We don't move as much as what you may see over in the European or the American sessions. That right there is where we thrive in this strategy, that lower liquidity to not push out those big moves, which usually a lot of people hunt for. We want the absolute opposite. If we can get a ranging market or a slower moving market, that is absolutely prime suspect for us. Okay, the time frames we're going to be looking at today are the 1 minute or the 5 minute. Today, we're going to be focusing on the 1 minute, and I do predominantly trade this on the 1 minute. The 5 minute chart does give the same amount of analysis, and you'll see later on when I am on the 1 minute chart, I'm still getting 2 to 3 days worth of data on my charts. So I'm trading the 1 minute time frame, but realistically, I am looking at a little bit higher time frames. I just like to get a clearer picture, but we'll dive into that in a little bit. When it comes down to signal frequency, okay, how often are we actually going to get a trade? You may get 2 to 3 setups a day. Whether or not you actually take those is another story, okay? So in terms of actual signals to pop up, you're looking at 2 to 3 a day, depending on the asset class you're watching, the volatility on that day, and how many assets within that asset class you're actually keeping your eye on. That's kind of an overall preview on setting up. Okay, now let's start diving into what is actually required from your side. Guys, I understand the slides right now just say strategy preview. That is on purpose. I'm going to talk you through this rather than showing you the overall slide. Okay. Number 5 that we're going to look into is the learning skill. How hard is this to learn? How difficult is this to really take under your wing and trade? And I put it at a difficult level. Okay. I'm going to be able to break this down into a very simple strategy, a step-to-step process in which you can follow. However, coming down to when you actually pull the trigger and how you manage the positions once you're in is where the difficulty comes into play, which is actually where the profits come into play. So I can find you entry signals, I can find you an edge in the market, but then how well you manage that edge throughout the trading session does depend on how well you get profit. And I'll talk you through this in a little bit. So I'm going to mark this learning skill as difficult, as it is a little bit more complex compared to some of the other strategies you may be familiar with out there in the markets. Okay. As I mentioned, the skills you need are advanced position management, being able to hedge a position, being able to cut losses, cut winners, scale in, scale out. All of these things, they're very intuitive. They're very based on experience, and it can be quite a difficult thing to teach without kind of doing the learning itself. Please keep that in mind. To really take this strategy tomorrow and run to the hills with it, you will need a lot of experience in advanced position management and in pattern recognition, understanding when the market is starting to turn, whether for you or against you, and then being able to act on behalf of that. Mentioned before, the expected screen time is quite high. We're day trading here. Okay, you're going to need to be in front of the screen for 6 to 7 hours, depending on the Asian session, depending on the session that you're going to be trading. And then the preparation requirement. Okay, you're going to need to define some key volume levels. Okay, which take about 5 minutes per asset. There is a whole fundamental side to this strategy. I'm not going to have the time to dive into that. I think I'll be able to do the whole 6 hours myself if I were to dive into the whole fundamental side. So I'm going to leave that out today, but you can catch me later on another day if you want to find a bit more about the fundamental side of things. Okay. Now, an overview. Okay, we've got a preview. We understand what's needed from us. We understand what it's going to take in order to actually succeed with this strategy. Now let's have a look at what it actually entails. What do we really need, and how do we act on the signals that this strategy is going to give? Okay, first things first, Asian session. It's where I sit. Okay, you can look wherever you want. You will be able to find opportunity in the London session, the US session, in any market, I'm sure, because this is based on simple volume geometric supply and demand. It's very, very easy, and the concept is crystal clear. However, I find the most profit in the Asian session, which is why I'm going to talk you through the Asian session today. We're going to need the volume profile indicator, and we're going to need volume indicator. Now, the two assets we are going to be looking at today, the low to medium liquidity FX pairs and indices, they are CFD based assets. Okay, so the volume profile and the volume data we will be using is based on tick volume. Very important we understand that these are not real volume metrics. These are tick volume. Now you can get about an 80 to 85% successful hit rate on the difference between tick volume and real volume, but there can be little mishaps, which is something we need to keep an eye on. And there's a way of doing that by cross-checking a number of different liquidity providers just before entering a trade. But once again, getting a little bit more complex. Okay. Looking into where we need to really be aware of, we need to understand support and resistance areas, simple terminology, and as I mentioned, those higher volume spots as well. How are we going to be entering the market? We're going to be using both limit and market orders depending on how the strategy plays out. Our expectancy, or risk to reward expectancy, sits around an average of 1.47%. Sorry, 1.4R. I've confused myself there. 1.47% for every 1% risk. Okay, 1 to 1.4. Got muggled in my own words there, but that's around the expectancy that we achieve. That is when we actually get in the trades. Our risk to reward ratios are usually set at around 2.7, if not higher, to about 5. but based on statistics and when I manage these positions over the 12 months, I've averaged about a 1.47. Okay, so it's very important you understand that. Sorry if I'm talking too much, Vit. I'm just trying to give you the whole rundown on what's going on. Accuracy sits at just above 55%. Right now, over the past 12 months, I'm a little over 55%, which is where the accuracy is. So we've got a positive win rate and we have a pretty good accuracy. Okay, guys, I understand there's a lot going on. I'm talking a lot. So I'm going to slow it down and we're going to get into some diagrams. We're going to get into some things that you can actually see and talk with me. Okay, let's start moving this a little bit round. What do you need to really succeed in this strategy? What do you need? Where do you need to be? Okay, we're going to need the previous days / weeks data. Australians, they love to talk. We sure do. We sure do. We're going to need the previous days data. You say the win rate again? Sure. We have a just and over a 55% over the past 12 months trading this strategy alone, just over 55% win rate. Okay. Looking at the tools needed, we need the previous days and the previous week data to have a look at these key levels. We need some kind of drawing tools, whether you do this manually, I highly doubt it. I'm sure majority of the traders here on MetaTrader 4, MetaTrader 5, TradingView, whatever it might be. We need something that we can draw tools with. We need an economic calendar so we can get an understanding of when high reactive news is due, because we don't want to be trading during those times. As I mentioned, we're looking for low volatility. We need the volume profile and we need tick volume. You won't be able to get real volume in the FX market. You won't be able to get it in the indices market unless you're trading futures contracts either. So tick volume is where we're going to be sitting. Okay. Fundamentals. As I mentioned, I'm not going to dive too much into this because there's a lot going on. But what we need to understand was, especially in the Asian session, overnight during the US session, was there news? Okay, was there big fundamental shifts? We've seen the US dollar, Japanese yen recent times have moved. We've seen the US dollar through CPI data recent times done big moves. These things affect the trading day and the following day. So we need to be aware, were there any big major announcements the day before? And are we going to have a reactive day to that? Once we've done that, we need to have a look, is there news today? Was there planned news, unexpected data yesterday? Is there planned news today? What kind of reaction are we expecting from this news? That's where the in-depth analysis in fundamentals comes into play, but we'll dive into that another day because we'll be here for 6 hours. I don't want to be here for 6 hours. So we'll dive into how to access those fundamentals and get a bit of an understanding on the overall market bias at a later date. But if you do have this edge and you do have this little piece of the puzzle that you can bring in yourself, even better, because it's really important you get an understanding of where investors want to move the market. Analysis and setup. Once again, we're contrarian strategy focused on fading. Okay, what do I mean by fading? Bear with me one moment. A quick drink before I pass out. What do we mean by fading the market? Well, essentially, we're going to go against what everyone else is doing. I mentioned earlier on in the webinar that this strategy I built around my personality. I could not hit the nail on the head any better than that. I like to go against the crowd. I like to do what other people aren't willing to do or don't do. I like to be a little bit contrarian in who I am. I've noticed that over my short life so far. And this is why I built this strategy, because it fits my personality. Now, if this resonates with you, fantastic. Okay, fantastic. Take this on board and learn to trade this strategy, because once you get a strategy that really fits your personality, it is so paramount that you can just deliver with confidence. If this doesn't resonate with you as much, that's perfectly fine. Depict what I'm talking about. Take the bits you do like that do resonate with you and multiply it onto your strategy to provide you with an even further edge. Okay. So what are we looking at? US dollar, Japanese yen, and XJO. These are my two most traded assets over the past 12 months. Okay. Now, I don't trade futures, so I don't trade the XJO itself. I trade the Oz 200 CFD. Okay. So you may see the Oz 200, the AU 200, the XAU 200, whatever it might be, depending on your liquidity provider, the CFD of the S&P/Oz 200 or the XJO is where I'm predominantly based, as well as US dollar, Japanese yen. As we mentioned before, 1 to 5 minute timeframes, usually sticking towards that 1 minute, but there are occasionally times where I will look on that 5 minute, depending on my time frame and what my day outlook is looking like. It's very simple. This is my strategy broken down into the simplest form possible. When price tests strong volume areas with lower volume behind it and it's overextended, we look to fade it. Simple as that. Simple as that. That's all we're going to be doing. When price tests strong volume areas with lower volume and it's overextended, we look to fade it. Now I'm going to run through a couple of example trades, which I think is what you guys want to get to, okay? But, miss a slide. What is the trigger? We know what we want. We want to move into a strong volume area. Okay, we want volume to be dropping. We want to be overextended, and then we're going to fade it back into the market. But how does it actually work? There's two entry signals in this. We've got a safe and we've got an aggressive. Personally, I like to be aggressive. However, I am very experienced in trading this strategy. I do know what it's capable of, and I do know how to manage my losing positions, to cut losses or to hedge those positions almost instantly if I feel I'm wrong. So I don't recommend going with the aggressive strategy. I will still teach you it and I will still show you how I do it. However, for the sake of this webinar, I do think it's important that you become familiar with trading the strategy prior to going aggressive with it. So our entry signal is going to be when price trades at lower values, okay? When we break a bit of support, when we break a bit of resistance, whichever way it may be, that's when we're going to start looking to trade. And we're going to be trading market orders. If we're looking realistically to trade at lower values or higher values, we can set limit orders. I always prefer to do market orders because I feel more engaged in the position. If I have a market order, a limit order or a limit order set in the market, I find that I kind of zone out and sit back a little bit, which is exactly what I don't want to do when I am trading the strategy. So it's very important we're aware of that. How do we set our target and stop loss? Our stop loss is going to be above recent consolidation or the other side of key volume areas. Now I'm going to show you in just a moment how we decide these key volume areas, okay? Our take profit is going to be volume zones. Slow movement in our favor. If the trade's going in our favor, but very slow with no conviction, that's going to be a sign to look to get out. And then also look at some value areas. Once again, I'll show you how I manage the position in a couple trades in just a moment. When it comes down to risk management, the ideal risk per trade is 0.25%. I never go more than 0.25% per position, usually sit around that 0.15%. 0.25% is when I'm really confident. Now, that may shock a lot of you. I know a lot of you may sit back there and be like, I risk 2-3% per trade. Look, if you want to show some serious longevity, if you want to be able to beat the annual market returns and you want to be trading at big funds, you need to hone in that risk management and really ensure that your drawdowns are kept to an absolute minimum so you can outperform different markets and different investment strategies. If it goes in our favor, this trade, we're going to be taking partial profits and we're going to be using indicators to decide where we're going to be looking to get out. If it goes against us, we're going to be looking to scale out and reduce the risk, or we're going to hedge the position if we can see another pivot point where we could potentially turn. That's a very difficult skill to master because you can get confused between hedging and simply holding on to a losing trade. So I do not recommend trying to hedge if you are new to the idea of hedging, especially if you're trading a new strategy. Let's just stick to the scaling out / reducing risk on the positions. Okay, has everyone followed me? Have I made sense? I know I've just spoken a lot. I really apologize for that. I'm Australian. We do it. We talk fast. We live life fast. But I really wanted to give you as much value as possible in the short amount of time we have so we can dive into some examples and really show you how to break it down. Okay, so I hope you guys are following along. If you do have any questions, remember, send them in. Michael's watching with a close eye to ask me right at the end. The two trades I've picked out today are from earlier in December. We've got one on US dollar Japanese yen, which delivered a 1.77R return. And we've got one on the Oz 200, which delivered a 2.76R return. Okay. And we're going to show you exactly what these positions were. Let's move in. US dollar Japanese part 1. Okay. I've set up this strategy and dissected it all into 7 steps. both of these trades are dissected into 7 steps, okay? And we're really going to run through what these 7 steps are, and I want you to be able to replicate this. Now, even if you trade this, even if you trade your own strategy, breaking up your strategy into step-by-step processes that you can even tick off a box, I think is very important. So our step 1 is to look. I'll wake up in the morning. If you look at this chart, I hope you guys can see it fine. You'll see right at the current prices is when the day begins. It's a new day, a bright new day. It's 9 a.m. here in Australia. Bang, new day. Let's have some fun. I'll scan through all the charts. Usually, surprisingly, US dollar, Japanese yen, and the Aus 200 are the ones that stand out for me. There may be something behind that. And I look for a asset which is kind of opening up within yesterday's day's range. So you can see we had the high of the day yesterday, the low of the day yesterday, which you can see on your chart there. And we're opening just towards the top end of that range. That's where we want to be sitting. Okay, we're going to review yesterday. We're going to make sure there was no fundamental news, unexpected or planned. And we're going to look for the key volume areas, which I've circled in the volume profile here. Okay, you can see the 5 blue circles. These are the key volume areas. Now we've looked, we found it. Okay, fantastic. Our next step is to draw. Let's start drawing in these lines. These key volume areas which we have circled, I now want to draw. I want to mark these using extended rectangles so you can clearly see them into the future. And these are going to be our basic areas that we want to trade around in today's session. We found an asset. We're opening up within that range, and we want to trade within those areas for this next session. Okay. Once we've drawn in, it's time to sit back, drink a coffee, and relax. Okay, can you explain how to find real volume, not tick volume? Charlie, we can't find real volume on CFDs, I'm afraid. We do base on tick volume. It's an 80 to 85% hit rate, okay? So we be patient. We wait for price to come to test one of these areas. You can set alerts if you like setting alerts. As I mentioned, I like sitting in front of the charts. It's a long process, right? You can chill out. You can get ready for it. It will be patient. It'll test your patience. It'll like watching paint dry, but sometimes trading is a bit like that, even day trading. And we wait for price to come up and test these areas. As you can see in the US dollar, Japanese yen, early in the morning here, we did come up and test into this area. Now we analyze. We've hit where we want to hit. Let's analyze. Let's have a look at what we're looking at. Okay, US dollar, Japanese yen is done a 56 pip rally. Usually in US dollar, Japanese yen, at least in the early Asian session, we sit around a 60 to 70 pip average movement. Recently, it's been a little bit more than that, given everything fundamentally that's been happening, but we usually sit between that 60 and 70. So once we start getting into those areas, I'm starting to like the idea of fading it, because I know based on probability, that's as far as we can stretch during that day. So price has climbed a 56 pip rally straight into a predefined volume zone, while tick volume, as you mentioned, is dropping. So you can see down the bottom of the chart, the black arrow there pointing the downside. We're extended, right? We've done the average day's move. We're extended into a volume area. That's the second one we're looking for, with volume dropping. That's the 3 checklists right there. Okay. We've analyzed. We understand this is an opportunity. Okay. Now we continue our analysis. We need to find at what points do we want to enter the trade? At what points do we want to exit the trade? For now, we're going to look at entries. Our aggressive entry will be that top line, as you can see right there. Straight off the bat, early on, volumes dropped. We're in that area. If we get down, sweet, let's short it. Okay. Our passive one, our more relaxed and more conservative entry, is going to be that second one down there marked as passive. So we have our trade idea. We have our setup. We have our entry points. We need our exit points. You always need your exit points prior to getting into a trade. So once again, if I'm on the aggressive, I can see I've pulled it in just above that top volume profile area. Okay. Our passive is just above that. I'm not sure you're going to be able to see it, but I do have written in brackets there. It's above yesterday's high. Okay. So if we have enough volume to break yesterday's high, I want to be completely out of a trade. That's where I'm placing the stops. And then the blue lines, the 4 blue lines I've set there, are my targets. Target 1 is the first area where I think we're going to hit a bit of resistance. Target 2 is my prime spot. Okay. We're chatting on the 1 minute here, Bankol. Target 2 is our prime spot where we're going to be sitting. That's really where I want to get out of the trade most. And then we've got target 3 and target 4, which I think we can get to, but it's going to be more and more unlikely. When setting targets, I think it's very important that you analyze, if you were long, where would you look to enter? And if you can find those points, they're the points you should start looking to get out of the trade. Once we've finished analyzing, we trade. Okay. We found our entry point. We found our trade idea. Entry points, exit points. All we have to do now is trade it. Bear with me. Doing a lot of talking here. All we need to do is find our entry points. I'm an aggressive trader. As I mentioned, I like to go aggressive on this strategy. However, I have been trading it for over a year now, so I am quite used to what it can do and how to manage when it goes bad. So I don't recommend trading aggressive. I recommend the passive trades. However, for the sake of this, I am going to show the aggressive ones because they're the trades that I took. Went straight in on the aggressive, hit first target, took 25% of the position off, right on where we spoke last time. You can see target 1, that top blue line. We pumped into there, took 25% of the position off, got down to the most likely target, took another 50% of the position off, right? So that's 75% of our position closed. And then as we pushed back up above that recent high, that new blue line is where I got out of that position. Very simple. I didn't get down to my target 3 or target 4. I got completely out of position there, but I ended up finishing with a 1.77R return based on managing that position as we went through. Okay. I know this is going to be a little bit quick, guys. I know it's going to be a little bit rushed and it may be a little bit overwhelming, but I am trying my best to break this down. But as you can see, I took 0.25% in that first little move. I took 1R banked into that 50% of the position close. And then I took another 0.5R as we broke that high that we made when we did hit that 50% position close. So our part 6, once we've traded, our part 6 is a review. So we review the position, we have a look. How do you feel about it? Write in your journal. What do you think went well? What do you think went wrong? And then part 7 is to validate. Okay. So you want to make sure you really validate the areas in which you land in. Now, unfortunately, I am running a little bit out of time, so I'm going to rush through this one once again. Okay. Same thing. Part 1, we look. This is on the Oz 200 earlier in December. We look for areas of bounce, the blue circles. Part 2, we draw in the areas we want to bounce. Part 3, we wait for price to test one of these areas. As you can see here, we tested this area, but we had an increase in volume. So I don't want to trade it. But as we got into the other area above it later on, we tested up into this area with a decrease in volume while we had an increase in price. So that was better for me. Okay. Once we found that, we look to analyze, okay, how far have we gone? 0.52% move. Fantastic. We're a bit extended. We've got volume divergence. There's my aggressive entry point. There's my passive entry point. There's my stops. There's my targets. Once again, we trade it as best as we can. The target 1, I took 25% of the position off. Target 2, I took 100% of the position off solely because I didn't see us getting any further and the market was going to close. We're trading the Oz 200. The stock exchange does close. I know that's very rushed. I do apologize, but we are running out of time, believe it or not. Part 6, you review the trade, 2.76R return on that trade. Fantastic. And then part 7, you validate the areas. Did you draw the areas correctly and did price bounce off them? And as you can see, based on probability, those areas were very efficient. So you know that you are drawing them correctly into the next day. You can do it with confidence. So probability is in your area. We only had one area in where we didn't see a slowdown. Okay. Now, I mentioned earlier that I am the chief of content of Trade Delicious, and that what Trade Delicious is a brand new entity and network for all traders to enjoy. We've just started a brand new YouTube channel where we do a whole heap of live trading, webinars, podcasts, all the type of entertainment by traders for traders. So if you want to see me trade this strategy live, if you want to come and join me in a trading session on Friday where I will be trading this strategy live, head over to tradedelicious.com or youtube.com/tradedelicious. Give a subscribe, turn the notification bell on, and you'll see a whole heap of me as well as other people in this webinar ahead of today, where you will actually be able to see us all trade all these strategies we talk about live in front of you on real accounts and really just having a great time doing it. So if that does sound like something you want to get into, it does sound like you want to watch what we do, what I've just spoke about, watch me do it day in, day out, head over to tradedelicious.com and you'll be able to find me and everyone else over there and check when we're going to be next live. It's all completely free, all completely free. Then finally, that's right, I've got a suitcase behind me, a new Christmas present for me, because I'm going to be heading over to London in June 2023. We are going to be heading over to London. I'm making the big trip to the other side of the world to meet you guys in person and talk about Edge. I'm going to be doing a little speech, I say a little, a webinar, should I say, about Edge. What is it and how to find your Edge, how we can build it and understand it so you can have more conviction when you are trading. So do come join me. I think it's going to be an absolute blast. We're going to go to the pub afterwards. Let's have a beer. Let's sit down. Let's talk trading and let's meet all the 5ers team together and have a fantastic trading event in London. Guys, I really hope you enjoyed it. I know it was a little rushed. I know I spoke a lot and very quickly, but I do hope you did get a bit of understanding on how I trade and how it all works. I really do. Let's see if we can pull Michael back in here and rip into him.
Hey, Jordan. Yeah.
Hello.
How's it going? How you feeling?
Yeah, I'm well. I'm well. I spoke very quickly.
Okay, yeah.
I had a lot of information. Delivering a whole complex strategy in a short amount of time isn't an easy thing to do, but I really hope I delivered what everyone was expecting today.
Yeah, definitely. I see the chat right now and the guys are loving it at home. And you know what, just before we will end this presentation, let me ask you some questions that the guy left in the chat box. And then we will get to the riddle, the question that you have in order for them to go straight to the raffle. Okay?
Mm-hmm.
Yeah, so basically, let's start with the simple one. What is the pips target of this strategy?
Okay, I don't have a set pips target. I don't trade based on any pips when it comes to stop loss, when it comes to take profits. It's all based on volume areas. It's all based on price action. Right. I don't mind if the next level's 100 pips away, if it's 2 pips away. It doesn't bother me too much. So when it comes down to set targets and set stop losses, etc., it doesn't really fit into the strategy. It's not something we can do.
Right. So basically, let's say you go to a 1-to-2 ratio, a 1-to-3. If you want to basically find the right ratio between the risk and the reward.
Yeah. So you want to have a look at what the actual chart is telling you in what's going to be achievable in your targets, and that's how you can set your risk reward ratio expectations that way. Gotcha.
And another question that repeated itself, basically talking about the volume, since we know that in Forex, we don't have really volume besides the tick volume. Can you share a little bit about that and explain how to find the volume, the real volume or reliable volume?
When it comes down to FX pairs, it can be very difficult to get real data, especially since it's decentralized and goes all around the world at different times. So a lot of the CFD brokers do provide us with tick volume, which is based on how many orders go through, not the size of orders. This data is remarkably similar to what you can get out of real volume data. Sometimes it differs a little bit, but what I find is if you have something that looks a little obscure or doesn't quite look right in the volume charts based on what the candlesticks are telling you, it's very easy on a platform like TradingView to pull up 4 or 5 different brokers' feeds of the same asset, and you can cross-check it across those CFD brokers and get an understanding of whether or not your liquidity private stepped out of line or the whole market has actually done that.
Yeah, that makes totally sense. So just before we will go to your riddle, the question that will get them into the raffle, guys, let me tell you how it's going to be. You're basically gonna get a link right now in the chat box. You will click on that link and you will answer to the questions Jordan will present to you in a second, okay? So only answer in the link that we are sharing right now through YouTube, through the chat box. So take it away, Jordan. Ask
The question I want to leave with traders today, and I know it's going to be a little bit hard to depict it because I went through it so quickly, but it is, why do we set multiple targets when trading? Why are we looking at partial profits in certain areas? Why are we not just setting a fixed target down the bottom? Why are we looking to take profits early on a fade play?
Okay, that sounds good. And I just got a confirmation that we shared the link through our chat box. So guys, go to the link, leave your answer there, and you will get through the raffle in case you get the correct answer. And like I've mentioned before, you are potentially going to win some amazing prizes, 6 tickets to our live event in London in the upcoming summer, and also 12 evaluation accounts to trade our capital. So go ahead, answer through the link. Thanks so much, Jordon. That was fantastic, like always. And as Jordon mentioned, you will see him also in our live event in London, UK, June 2023. So
fantastic.
Just before we're gonna,
thank you for having me, Michael.
No worries. Just before we will go on a 5-minute break, that's all. Grab a coffee.
Maybe pet your dog. And when we come back, our favorite guest, the guy with the most accent, but also will show you an amazing opportunity in the market today. He will basically share his own unique strategy on how to use volatility to find your edge. So we'll see you in just a few minutes, 5 minutes. Take care. Okay, guys, so we are back from our break. Just before we'll have our next guest, let me remind you what we just had before the break. So Jordon basically talked about the way to trade the markets without the trend, without the help of the trend. And we also had the raffle. In case you missed that, just go back, watch Jordon presentation, and at the end, he will ask a question. You need to answer it correctly to get into our raffle and potentially win great prizes. So let me introduce our next guest. His name is Ruben Abitbol. He's French guy and is a little bit devastated from the World Cup still, so give him a slack. Ruben, join us.
Hi guys.
How's it going?
Hello, hi Mickey, how are you?
I'm great.
Great.
How about
Thank you.
Are you ready?
Yeah, I'm ready, but you know what?
Yes.
Stay with me.
Okay.
I will need you for an experiment as a guinea pig. Can you give me the tools, someone? I need maybe,
What
scissors to make a surgery.
Oh, surgery. Okay.
Surgery.
Gotcha. No worries.
I'm joking, you can go.
Thanks. Good luck. Take care.
Hello guys, thank you for joining with us. The marathon, I'm going to talk about volatility, which is a subject that is follow me during 5 years that I've been starting trading. So before I start talking about the strategy, let's talk about myself. Okay, so as you know guys, I'm French. We lost the World Cup, but we still have baguette, so I think that's fine, but we're still happy. I'm actually responsible for the risk management at the 5ers, also in Trade the Pool. I'm managing all the trading desk here. I'm making 2 trading room per week at the 5ers, so you can also join me on the YouTube channel of the 5ers. I'm making 2 days a week a trading room. I'm 26 years old, and also I was trading options during 2 years. That's, give me the perspective and understanding about volatility. So stay with me, put your seatbelt. We go back 5 years ago when I start my first pass into trading. I was trading into a traditional prop firm as a junior trader. I was options trader. I was trading commodities, but anyway, when I started by trading options, you don't care about the direction of the price. So my first step into trading was not to know and was not to knowing about where the price of the asset is going, but only to expect something about the volatility. Okay, so this is why we've been talking about volatility. So let's give a definition of what is volatility. So as you can see here, volatility is a statistical measure of the dispersion of returns for a given market asset. Do you understand what is it? I took this from Wikipedia or something else, but you know what? I'm kidding. We will give something more easier to understand to understand what is the concept of volatility. Here we have Usain Bolt that is running. His heartbeat is getting higher and higher. You see the frequency of his heart getting higher and higher. In contrast to someone that is sitting, chilling on a chair, is actually the heartbeat is slower. So this is the difference between two volatility, and we can also take this into trading. Okay, so high volatility. You can see here that we have commodities, which is a high volatility asset. We have cryptocurrency. We have stocks, and in the low volatility, we have, for example, Forex. We have bonds and other assets. Okay, so this is the two main difference. We have two different of volatility. We have low volatility and high volatility in assets. But we can also define volatility by the event that can affect the market. So for example, in low volatility, you have the London session, you have the ASAN session. Jordon just before explained your strategy that was trading about London session, which is a low volatility, let's say, moment of the day. In opposite to high volatility, when we have high impact news and where we have the US session, because there is high liquidity, high volume in the market. So guys, I'm keep talking about volatility. Okay, so why actually I want to talk to you about volatility? volatility is something that will give you the hedge into the market. You will actually finally understand why the market behave so far, and actually you will be able to trade as institutional trader by understanding the concept of volatility. So here we have a theory that this is something I took actually from the theory that I will be talking about. The theory is reversion to the mean. Okay, let's say we have a high volatility movement. Okay, so we see, for example, here, the market will tend to go back to the middle. Okay, so that means when for example, if we take Usain Bolt, he's running. Okay, he have a race. After he need to slow down and need to count down, the volatility of his heartbeat, so his frequency of his heartbeat, will slightly going down. So this theory is working for volatility, but what I try to do, and that's why I'm going to talk about today, is how we can implement this theory into live trading, which will be Forex, can be stocks, can be commodities. So we want to understand the direction of the price. Here we have also another example when we can see, okay, just hold on. Okay, here we have another example where we have an uptrend. Okay, so here is the average, this is the mean, and you see the price is making waves, okay, but all the time going back to the middle of the point here, which is the mean. Okay, so like I said, I want to bring this mindset into directional trading, the concept of options that I've, been trading 5 years ago. And actually it took me a lot of time to take this concept and bring it into directional trading. Here we have the two main indicators that I'm using for my strategy. The first one is Bollinger Bands, which is volatility indicator. It will tell us at any moment of time where is the volatility, if we have a high impact or if we are close to the mean. The Bollinger Band will tell us how far we are from the mean. And the second is stochastics, which is a momentum indicator, and stochastics will give us, let's say, the confirmation that the movement is an overextended movement. I will explain it deeper just after. Of course, you need to understand a little bit some concept of price action, supply and demand, technical analysis to combine all the things together and have the best entry possible in the market. So here, how should look your chart? This is a chart preview, US Bollinger Bands, okay, which you see the line in the middle is actually the mean and the average. And then you have the higher Bollinger Bands and the lower Bollinger Bands. We call this 20 standard deviation. We call this when the market touch here, which means that we are 20 standard deviation far from the mean. Okay, but let's keep this concept into me. Here is the mean. We have high Bollinger and lower Bollinger Bands. Finally, we have stochastics. I will also send you in the PDF that you will receive after. You can get actually the settings about what Bollinger Bands are. But here we have 2 standard deviation Bollinger Bands, and we have 14, 8, 5, which is the settings of stochastics. So here are the 2 settings I'm using. So now what I'm looking at, why now I have the 2 indicators, I need to understand what I'm looking into the chart. So the first thing is looking at the extreme, one of the extreme into the Bollinger Band. So when the price will touch or will go straight forward into one of the 2 extreme bands, which is or the upper band or the lower band, it will give me a way to enter the market, or it will actually tell me what to do. The second thing is having stochastics, which is I will take when stochastics is crossing below the 20 line chart, I will take an entry, and when the price is going above 80, I will also take another entry. I will show you some example, guys, so you don't need to be afraid about what I'm telling right now. It will be easier to understand what's happening into the market. Okay, so the first thing you have to do is create your work plan. You need to go into a chart. Whenever I said it is, you want to, make a surgery into your chart. So you need to go and create your work plan when you will have to enter, what will be your zone that you want to trade about. And here we are, we have an example here. So here we have an example of gold, which is the daily chart. So you see, I put some key zones in the market. So this is something quite easier to do. We have here, for example, a triple bottom, which is, indicators that is, let's say a support, or we have also a demand here. Here it's also key zone because we have actually two top, and then we break out and we have a retest. So this is also a key zone for me. Then we have another key zone here. You see it's quite the same. We have multiple touch. Here we break and then we have a retest here. And actually, recently, we actually reach into this zone, and we want to say, okay, actually the price is in a zone that I want to trade, that I want to take any execution. So I go to lower time frame, and I actually try to understand what are the trends. Okay, so I need to identify the trends into lower time frame. Actually, on the H4 chart, we have an uptrend channel. You see also that the market is quite losing momentum a little bit because we have lower. You see here the dispersion is starting to get higher and higher. It looks like a compression. We also have Bollinger Bands. As you see, we have actually all the time the price reach into the top, the market tends to go down again. And then we want to find some setup. So here is one setup that I identify, for example. So here we are at the bottom of Bollinger Bands. You see it's going bigger. Here is a demand. So we have a demand here. Here the market go straight into the demand, and we have stochastics that is starting to cross below 20. So guys, I repeat, this type of setup can happen many times, but here we have a huge sell-off in the market going straight into a demand, and Bollinger Bands are getting bigger. We are at the bottom of Bollinger Bands. Market is losing momentum because we are crossing below the 20 level. It will tell us, okay, here this might be a signal for me to go into the market and take profit from it. Here we have another example in dollar yen. Let's go straight into the dollar yen. Okay, so the first step here, I go to H1 chart. Actually, it's holiday, so I take this chart from my last MT5 platform. So you see that it's like the volatility is starting to get lower and lower because we are in holidays. But actually, when we have low volatility, we can take hedge in the market. So here, what's happened behind me here on the screen, you see that we have a small uptrend. There is low volatility because the movement ups and down is getting lower and lower. And also we have this zone. This can be also related to the supply that we have in the small here in the left screen. Here, if we go and we make a zoom into this chart, we have so it's the M15-minute chart. It's the 15-minute chart in the dollar yen. The market here is having a high movement in the top. We see that we are crossing Bollinger Bands. So here we are actually crossing the top of the Bollinger Bands. So I want to dig and check if the move is rational or not. I want to say, okay, we are in holidays. Why the market actually in this uptrend want to go even higher and higher? And Jordon also explained you before that when you look at, for example, London session, you want to understand what type of news there is before and after, and if there is any reason here for the market to break this, trend line that we see just before. Here we go to lower time frame and we see, okay, here the market is giving us an indicator that, a price action that the market is losing momentum, losing volatility. Here stochastics is crossing above 80. So here also is an indication for us that the market will go back to the mean and will reverse. Okay, this is also one example. Top Bollinger Bands, stochastics is crossing above 80. This is an indication for me to take execution into the market. We have here another example, which is on the S&P for people that like to trade indices. Recently, we have a very interesting move. This was, I think, last week. It was also holiday just after Christmas. And then you see here, we have a big demand zone here on the H4 chart. It's something that we can highlight. It's very easy to see. That's why also I invite you to stay in our marathon event. At the end, Gil will explain to you supply, demand, and Quasimodo. So you will also get a lot of tools to combine all the analysis that you can bring into your trading plan. Here we have a huge demand. This is quite easy to see. And we want to understand what is this move. You see there is a high movement actually that is happening. So I go to lower time frame. M30 is good. M15 is good. And here we see on M15 that we have a huge volatility movement straight into the demand. And you see, like, it's like, you know, someone that have and make, you know, 50 push-ups, 70 push-ups, 100 push-ups, you know, guys, at the end is starting to be tired. And here it's exactly what's happened into the market. The market, you see, we were at 3,900 going straight into 3,700. There probably was not a big event. It was during holidays. And we have also stochastic that is below 20. You see it starting to cross over here. We have also a small price action, but here it was quite a nice entry that we can have. And that's why we need to understand what is volatility at any moment of time. I hope this is clear for you. Okay, here we have the Aussie dollar. So here is an example of the Australian dollar. H1, again, we do the same thing. We have to identify the key zones. So here is a big key zone. It was a demand. We break it here and we have actually two retests just here. Important to see. Okay, I want to go dig deeper into lower time frame to try to find a spot where I can execute a trade. Again, I go to lower time frame, I identify the trends, okay, and then in the M15 minute chart, we see an uptrend. Very easy. We have also the mean, which is on the middle. Here we are at the top, okay. Again, top of the Bollinger Bands. We are far from the mean, okay. If we take this as our work plan, here is the mean. So I expect the price at some point to go back to the middle. And here also we have in the M15 minute chart stochastics that start crossing. So here also is a nice execution. Okay, I have a question for you guys. I will need your interaction now to, I need your interaction. I had actually 2 trades yesterday. I want to review one of my trades with you. You need to tell me and you need to type on the chat if you want that I review you the trade that I made in gold yesterday or in the Australian dollar. This is actually a trade that I take in my account, again with the same strategy. I want to review this trade with you. So guys on the chat, let me know, which type and which asset do you want to review together. If we have more one, so type 1 if you want to review gold, type 2 if you want to review Australian dollar, and then we are going to discuss about it. Okay, I will try to fill the gap. Meanwhile, we get the answer. I'm starting to get here. We have some people that are eating sushi and pizza just in front of me. Guys, it's very disturbing. I need to understand what people want to look. Okay, actually, we have the same. Okay, you know what? Actually, it can be 50-50. So I might think by, giving you the boss trade I made. I don't know, actually. Anyway, let's look at gold. Gold was actually a nice movement yesterday. Here we are going to look the gold. Yeah, okay, here we are, the gold trade. So like I said, we were actually here yesterday. We touched the top of the range. We were at the top of the Bollinger Bands, and here we start by having a rejection. Okay, I go again into lower time frame. Here is the H1 time frame, and here actually the market is having a high movement. So we are going far away from the Bollinger Bands. We create a top here. So I need to understand actually if I can execute any movement. And here while going at the M5 chart, the market is not having any retracement. You see maybe here, but it's not enough. Here the market is giving us a rejection. You can also see on M1 time frame, we got this rejection. All the indicators are aligned. We are at the top of the Bollinger Bands. Stochastics is crossing here. This means that we are losing momentum. You know, keep this example in your mind that someone having 50 push-ups, 60 push-ups, 80 push-ups at the end is very tired. And here this is exactly what's happened to the market. The market was very tired. We are losing momentum because of stochastics, and the market is going back to the mean. Okay, I don't know about guys, but if you look the chart of gold today, the market get back down probably to this area, to this demand, even below. I don't remember, but the market get down far from this zone. So it was actually a very nice move that we can have. It's also during holidays that can, you know, put something even better, like it can give you another confirmation because it's holidays and because, you know, we don't have a lot of volume. This type of movement are not explained or are not rational to me. So that's why I've been selling the market here today. Okay, I also want to show you Australian dollar. You know, guys, we had quite boss answers, so I don't want to miss maybe people that ask for the Australian dollar. Again, quite the same setup. We have an uptrend line into the M15 chart. We have also a demand. We had here a key zone which was resistance and then create a demand, especially here. It's probably here a golden point because we have two price action and two zones that are crossing together. We have here a key zone and we have an uptrend line. We are also looking that stochastics is below 20, which means we are losing momentum. So I go into lower time frame. You see, actually, I took the screenshot after the market push, but here on the M30 minute chart, it's like the same. You see on the 20, let's say below the 20 threshold, stochastics is starting to cross. We are also at the bottom of Bollinger Bands. You see, it's also an indication for me that the market will push from here. So this was example into the two trades I had yesterday. Yeah, we just put the the book just here. So I probably went so fast into my presentation. If you guys have any questions, let me know. Michael will just join me here and will bring me back the question. You know, it's probably a new subject to you. Talking about volatility is not something common. Again, it takes me around 5 years to understand and bring this concept into directional trading. Again, when trading options, you don't care about the direction of the price. You want to expect what is the expected volatility. If you guys want to learn, let's say about options, call and put, whatever, or to make strategy to not trade a direction, I will be happy to make a course and to explain you more subjects. But again, here is to bring this concept. This took me a lot of time to understand it, and I'm applying it every day into my trading room, into my prop trading and my personal account. And this strategy is working. Again, guys, you need to backtest it. You know, you need to understand and bring this concept into your strategy. Let's say you're good at trading supply and demand. Bring this volatility concept into your trading and you will be able to hedge and find very accurate spot. So maybe Michael, you have some questions.
Yeah, wonderful. Thanks so much.
Thank you.
That was amazing.
Yeah, that was very fast also, but that's why we probably have a lot of questions in the chat. So ask me.
Yeah,
maybe people.
Thanks so much for this. The guys in the chat box are loving it as well. And we do have some questions. Let me grab them. A lot of questions. By the way, in case we didn't answer your question, you can send us through the email help@the5ers.com. Any questions, we will answer it So no worries about that in case we missed that in the chat box. So one of the guys asking, since FX is a low volatility asset, how do we use it for Forex efficiently?
Okay, you know, in any asset you will go, you can take Bollinger Bands that will tell you the dispersion of the volatility at each moment of time. So here I took some example, for example, in Aussie dollar, in the dollar yen, and you see Bollinger Bands, even if we compare it to another asset, which is commodities, which is way, let's say, higher volatility.
Exactly.
If we go to Forex, which is lower volatility, it doesn't matter because Bollinger Bands will, like, you know, make it like a, it will, I can explain, make threshold for high volatility.
Okay.
And lower volatility. Let's say if the Bollinger Bands are very tight, this means in the market, no matter which asset it is, we have low volatility. And if Bollinger Bands are getting higher, so we have higher volatility in this asset. So you can use and bring this volatility concept into Forex as well. And that's what I'm doing every day.
Okay, that's great. So basically, the Bollinger Band will fit to the volatility, to the right asset.
Yeah, definitely.
Okay, great. So another question is, where do you place your stop loss? Let's say maybe, Saul, can you show us maybe a chart for a second?
I will show you a chart.
Okay. Yeah, we got it here. So where do you exactly put your stop loss? How do you know that it won't, you know, just grab your stop loss?
That's a very good question. And I didn't go too far into risk management. I didn't talk about position size. I didn't talk about partial entry, but this is something that you need to check and apply to what you are comfortable with, okay? For example, here you can decide, you know, if you want to go full volume, you know, after the market cross, or if you want to take more space and have partial entry. Let's say you want to sell here and then to sell here again and then to sell here again, and then at some point you need to put the stop loss and have, I don't know, 1% risk. So I didn't talk too much about partial entry, but this is actually up to you guys if you want to go one straight volume or if you want to make partial entry.
So you're basically saying it's a discretionary, at least the way you looked at it, it's a discretionary trading. So you need to understand the market structure or the chart at the specific moment in real time, and then decide if you go all in or you scale in, how do you take your partials and those kind of stuff.
Definitely. That's why the name of the presentation is Create a Strategy around Volatility, which means that you have the tools and you know what to use,
right?
But you need to test it and to apply it into what you're comfortable. Maybe someone will be comfortable by opening full volume, and maybe someone will be comfortable by having partial entry. Okay. It's free to you.
And what about risk, not risk, actually, the win rate, the success rate of type of strategy like that?
Again, that's the same concept. That's exactly the same concept. Here, for example, if you see, for example, gold went down. If we go back to this chart on the H1, actually today, gold is actually moving here. Okay, right. So you can actually close some partial when the market go back to the mean. Here, if we take the M5 entry, the mean is here, okay? Because the mean is all the time moving with the market.
Right.
So when the market goes down and touch the mean, you can say, okay, it went into the theories all the time that the market will reverse to the mean. Here we go to the mean. We can close partial, we can close full. That's why you can use this strategy or for scalping, for example here, or you can use actually it for bigger time frame like H4, like we see in the S&P. Let me show you. For example here, okay, it's actually an H4 chart. We see that we are in the bottom of the Bollinger Bands, and the market just go back here at the mean. Okay.
Yeah.
And I just want to highlight something. We don't want to make a ping pong between the lower Bollinger Bands and the higher Bollinger Bands, because if we are here at the bottom, my take profit cannot be at the top, because it will, as a trader, telling us that we are a bit greedy. We all the time want the market to go back to the mean. And if I go back to, again, this theory, let me back again. For example, in the S&P, we touch the bottom, for example here, and then we touch the mean. Okay, so I want to exceed the market at the mean, because when we are here, actually we have 50% chance for the market price to go up and 50% chance for the market to go down. So that's why I'm using the mean, which is the, again, I go back to this, which is the, again, okay. I'm looking at this, which is the mean, which is the average.
So basically, we can say that, let's say, at least for the beginning, maybe, correct me if I'm wrong, of course, but at least for the beginning, you can aim, if you're going into the trade, you can aim to take partial, at least a partial, at around the mean, right?
Yeah, definitely. You can decide. Like, for example, myself, when the market go to 1-to-1 risk reward, I'm closing X% of the volume I have. Okay, for example, my stop loss is 1%. If the price goes into 1% profit, I will close 50% of my volume.
Okay.
I will put the stop loss to break even, and then if the price continue, this is bonus for me. Okay, so again, you can play with it. That's why it's create your strategy. You have the tools, and know you need to backtest it. Maybe it will work better in Asian session. Maybe if you understand and understand macro environment and macro news, you can also play with it when you have a high impact news. Try to react about the market.
Yeah, so
you can do a lot of things, guys, with that.
So that's maybe the second question, or the next question is basically the time frame, because the guys here in the chat asking about what time frame to apply this strategy. Can I use it for a 1 minute chart and also a monthly chart, or how does it go?
Okay, you can actually use this for any time frame possible. Actually, I cannot show you in different example, but it also works in monthly chart.
Okay.
Okay, if we look at the pound dollar, for example, that in I think in a matter of 2 months, maybe, yeah, in a matter of 2 or 3 months, the market dropped probably 9%, which in Forex trading, it's quite high. It's a big movement.
Yeah.
And if we take the example of Bollinger Bands, we see that pound dollar went down very far from the mean.
Okay.
And then actually the pound dollar, I think it moved from, if you take the euro dollar, for example, it was 0.96. Actually today we are 1.04, 1.05.
Wow.
We want this, so again, you can use it in monthly chart. You can also use it for scalping. Okay, when we go to a lower time frame, you have the same Bollinger Bands, but it's adapted to the time frame you look. Again, if you want to implement all of things, here, for example, in gold, which is the trade I had yesterday. Okay, so in gold, I'm having a higher time frame analysis. Right. So it's here, it's an H4. So I say, H4. Okay, we are at the top of the Bollinger Bands. So the market probably at some point will go back to the mean. It's holidays. We have low volume. Okay, maybe here the volume that we have is not relevant. It's not rational for me. And then here I move to M5. You see on M5 we have actually stochastics crossing. So you can combine the time frame.
Okay, so you basically start analyzing on a bigger time frame, then zooming in on, let's say, a 5 minute chart, right?
Yeah.
Okay.
And let me also highlight some stuff.
Go ahead.
If sometimes you can have like fake indication. That's why you need that Bollinger Bands to be to one of the extreme. Here we are at the top of the bands.
Yeah.
You need to be above 80, and you need to see like the stochastic starting to be flat. This is the two main important settings that you might see. If, for example, here we can say, okay, here there is a resistance, for example, here. Here we are at the top of the Bollinger Bands. Maybe I could sell here. Right. But then if you go back, you see here stochastics that is not starting to cross above 80. So you have, for example, you can have false indication.
Of course, yeah. And do you stay with the same parameters, you know, the 2 standard deviation and the 20 EMA?
Yeah, I am actually using 2 standard deviation, but if you want to get accurate entry, you can actually increase the Bollinger Bands. It can be 30 or 40 standard deviation, and then Bollinger Bands will be higher. Okay. And you can say, okay, here the market is even going so far. For example, if we had maybe I can take an example. Maybe here you see that Bollinger Band, the top is here.
Yeah.
If you have the 40 standard deviation, it will still be here. So you can have accurate entry with that. I'm using 20 standard deviation because this is something I'm using it.
Yeah.
And yeah, that's it. And stochastics, the settings I can actually give you it into the the PDF that we will send to our traders.
So now that you mention it, guys, at the end of this presentation, or basically the webinar, the event that we are hosting right now, we will put in the description a link to download the PDF of all of our presentations. You're actually saying right now, so you can have it and look at it right now in the chat, in the description, a link to download all of our presentations. So basically, go ahead, check it out, so you will have it in front of you. It will be easier to learn it with the video. So first of all, thanks so much, Ruben. It was really amazing. Guys, if you have any questions, just send them to help at The5ers or tradeapool.com, and we will answer them as well. Just before we'll finish, of course,
I have a question.
You have a question, and again, guys, in order to answer the question and get into the raffle, just click on the link that we are sharing right now in the chat box. So we are sharing a link in the chat box. Click on it and enter it, and then type in your answer in order to get into the raffle. And again, you can win 6 free tickets to our live event in London this June, the upcoming June 2023, and also 12 evaluation accounts to trade our capital. So yeah, the question, okay, there is not the question actually in here. Okay, here we have. Around which theory the strategy is built? Okay, I will just go here. Yeah. Around which theory the strategy is built. So I have the whole strategy. Yeah. What theory I'm using? So that's Ruben's question. Just go ahead to the link in the chat box, answer the question, and you will enter. If you answer correctly, you will enter our raffle. Alrighty. So we're gonna go on a break, a little bit longer than the previous one, so you can grab a lunch and maybe a snack, take your dog to a walk or anything like that. And later, when we be back, Saul will join us and share his unique strategy of a famous story of David and Goliath, and it's gonna be amazing, of course. So about 25 minutes, and we'll see you then. Take care. Okay guys, we are back from our quick break, and our next presenter is a tall guy, Mexican guy. His name is Saul. He might look like a little bit tired, not because he's trading the Asian session, it's just because he got kids. So, do you copy now? Yeah, so I had a great joke to tell you, but I was muted, so you didn't hear it. Never mind about that. Our next guy, his name is Saul, tall guy, and he will talk about David and Goliath. Saul.
Woo! Hey Mike.
How's it going?
I'm fine. How are you?
What are you doing with that?
This is my little sling.
Right.
I'm going to be representing David today.
Okay.
Yeah, let's see how it goes.
Yeah, so that's a $20,000 TV, so make sure you don't eat it, okay? Enjoy it.
Yeah, I will just need the control to pass the presentations, please.
Right, let me grab it for you.
In the meantime, we'll wait for people to join. And hopefully the rock I have inside here doesn't throw to the camera. Feels very stressed. Okay, guys, welcome to my presentation. My name is Saul. I believe some of you might recognize me from some webinars and classes, and you should be seeing the faces of these guys. They think the rock is going to fly towards them, or maybe to the TV. Anyways, let's move on. A bit of who I am. This is my 13th trading anniversary. I've been trading for 13 years old, for 13 years already. Starting back then in 2010 with, just trying to figure out what's going on with the trading, if I can make a little bit more of income. Took me 2 years to make it consistently, and since then, been just improving what I do already. I'm passionate about scalping. I really think scalping goes well with my personality. I'm not very good at, trading, holding trades for many hours. I'm just, more of a guy of taking profits consistently and repeatedly, and just repeatedly, doing that trade again and again and again. At the 5ers, you might recognize me. Been working here for a few years now. I'm in charge of some of the operation that goes here. And today I manage some of the many accounts, personal accounts and prop accounts. And to move on, let's just stop with this, okay? And let me tell you a story about David and Goliath in the markets. They're actually, we have this scene in the markets, or the story about David and Goliath, where the weak and brave David approaches Goliath and beats him. In reality, we have this analogy in the markets as well. We have two different movements in the markets that I'm going to present you, and we're going to try to train our eyes to recognize those and take advantage of what happens when we see these two patterns aligning. So we're going to recognize a weak pattern, okay, which is our David, and a strong pattern, a strong movement in the market, which is our Goliath. But actually in the market, the end of the story is most of the time, 70-80% of the time, Goliath smashes David, not as the story we all know. And this is going to be a strategy that you could potentially use on every time frame. Myself, I use it in lower time frames, in the 1 minute, 5 minutes, probably 1 hour time frame, because it doesn't present as frequently. So if you want to make like an income from it, if you want to have daily opportunities to trade it and to profit from this setup I'm going to present you, you will need to go to lower time frames. It doesn't mean you will not find this strategy or this setup in higher time frames. In fact, there's some pairs that are aligning with this strategy and setup that I'm going to present you. But in the daily charts, it's just going to present once a month probably these opportunities. So if you want to have like daily opportunities to profit, you might want to go to lower time frames. Again, I use it in the 1 minute chart. You might see me doing this on the trading rooms, and a lot of people ask me why, what I'm trading, what I'm looking at the charts in order to make the decisions I make in the trading rooms. And this is one of the setups I like the most. Okay, so a little bit of the overview. We want to identify, as I said, 2 patterns. The first pattern is going to be key zones in the market. Might be known as supply and demand area. Might be known as order blocks. Back then when I was learning how to trade, there wasn't all this concept of order blocks and all that terminology. It wasn't there. Okay, but it's all the same terminology to tell us or to refer to key zones. Okay, prices or areas in the market where there was a institutional movement, a really strong movement, either to the downside or either to the upside. And the second pattern, that's going to be our strong movement, our impulses in the market, and those are going to leave keys and limit orders pending to be activated and triggered. And our second pattern that we're going to try to identify, and we're going to train our eyes to identify, which is our dividend history, which are compression channels. Okay, all time of compressions where the market presses towards a certain area, and those are known as weak movements. And we're going to identify and go in depth on why are those weak movements. And then when we train our eyes to identify when a compression, a channel, a weak channel, and how can we identify that, approaching a key zone, okay, an area where in the past institutional traders or institutions were active and made a fundamental movement in the market, we are going to take that as a setup. Okay, so we're not going to need a lot. In fact, all we need is going to be naked candlestick chart. I will give you some indicators you can use to get extra confirmation to know if certain movement it is indeed a compression or not, if there's volume behind, if there's strength behind. But when with some practice you will not need it. You will need just candlestick charts, and you will need any kind of one-click trading or something just to execute your trades. Okay, actually the sling is not very useful in this case. So what are the supply and demand areas? Who are those Goliaths in the markets? The supply and demand areas are areas of interest where for some reason, and usually it's for fundamental or high impact news that were released or something like that, the banks or the institution created an important movement, okay, in the market. And we see that creating the price behind as a demand or as a supply zone, as a demand area, where the market just breaks from that area and takes time until the market and the price goes back to retest it. Okay, so we have a clear example here. This is the Euro US dollar on the one hour chart. So we see at this area right here, okay, there's an explosion, okay, a strong movement, and the market just continues to the upside. Okay, the market doesn't go directly to retest it or something like that. It just disconnects from that area and goes away. Okay, and that leaves behind an important demand zone, an important area where if we think that back then buyers were active and institutional buyers were active, so we can, okay, or our hypothesis or what we believe and why this works is when the price somewhere in the future goes back to that same area of interest, buyers will want to buy at that same area. Okay, at that same area, institutions, banks, whatever who moved the market at that time thought it was a valuable area, a cheap area, a good area to buy. So when the price goes back to that area as well, we assume that they will want to buy again. So first thing we need to do is to identify those areas. So if price breaks to the upside, that leaves a demand area. If price breaks to the downside, that leaves a supply area. And again, we have this moment right here. Okay, that's the 1 hour. Okay, Euro 1 hour, Euro USD 1 hour chart. And we see the disconnection from price from this area, and then just sideways, and then continuation to the downside. So the market doesn't go to retest that area soon. So that leaves what it's called a supply area, and it comes in different flavors and different forms. Okay, that might be a consolidation, then a breakout, might be just an order block, you know, an attempt to break to one side and then a breakout to the other side. You just need to, you know, train your eyes. If you follow our training rooms, you will see me doing this exercise, you know, many times to try to identify these areas of interest. So the assumption is whenever it goes back to that area, sellers will want to sell again. Okay. Now these fundamental areas usually happen because of high news events. You might be familiar with this, you know, news, the CPI, the inflation, FOMC, GDP, PPI, PMI, NFP. You will see many times when after these releases we have, okay, this kind of movement created. Not always, but usually they are formed after an announcement like this. Okay, we have a breakout, a disconnection from price from certain area, and then the area being created. Now, who is or what is our compression? Okay, who is our David in the story? Now, I'm not saying it's not brave. Okay, David is very brave because he's going to approach those areas, but it's weak. Okay, so what are compressions in the market? Compressions in the market are movements or look like channels. Let me move to this side, where the market, instead of moving as impulses, okay, and if we go back to see our examples here, okay, if we see instead of going just straight into one direction or straight into another direction as a breakout, the channel, okay, the compression is more a pressing movement, a channel. Okay, now what's important to know is to understand why this is a weak movement. Why is this considered a weak movement? And if we zoom in into this, okay, this is Euro USD on the dailies, and if we zoom in into this channel, and let me zoom in right now, okay, and it's the same channel, just zoomed in. Let's try to understand together what happened, okay, across the channel when it formed. Okay, so we had a little bit impulse to the down here, and then we moved sideways, and we have a little impulse to the downside. Okay, now this impulse to the downside formed a mini supply area, okay, a resistance area. Okay, so there were sellers willing to, you know, push the market a little bit, okay, in this impulse to the downside. But what happened is buyers were present, okay, there was a balance between buyers and sellers. Buyers bought the market and retested already that area, okay? So if there was some interest of selling here again, that interest, that supply was already consumed, okay? So if there were limit orders waiting there, if there was any interest of selling again from that area, it was already taken. Now that interest of selling again caused the market to drop one more time, a little, you know, a small impulse to the downside. And this little small impulse to the downside creates, okay, a small supply area, okay, a resistance area, a resistance level. And right after that, we have a retest of that. So that supply is already consumed. If there was any interest of buying, of selling the market once again in that area, that happened right again, okay, just after a few bars. That same interest causes another drop, okay, we went down again. That movement created a supply area, which was, again, retested already, okay, we retested. So across the whole channel to the downside, supply, and actually demand as well, is being constantly consumed. So all across the channel, we have no supply left, okay, because we're retesting, consuming all the time supply area. And you can see here, once we have enough buyers, we have a strong movement to the upside, because if now we have buyers that will want to break to the upside, there will be nothing to hold, you know, all the supply, all the resistance back here was already consumed, and we have a strong movement to the downside, okay? And as I mentioned, there's right now, as we're, you know, broadcasting this, gold USD, it is forming kind of a channel, okay? You can see the compression, you can see the weak channel that is forming on the dailies, and I mentioned you will have opportunities to take advantage of this pattern, of this setup also on the dailies. It will be less common, okay? You will have less opportunities, but you will see me looking for this every day on the 1 minute chart and 5 minute chart and taking advantage of these movements, okay? But right now, as we speak, there's a compression channel. What we need here is to see if we are trading at a key level in the other side, in our left. But this is a channel. We can use a little bit of indicators to to get some confirmation of the weakness. So this is the same chart. This is the daily chart of the gold against the USD. And if you throw any indicator, a volume indicator or volatility indicator, you will see that there's a divergence. Okay, you will see that we're kind of forming slightly higher highs across this channel, but actually in this case that's the RSI, the relative strength index, is pointing down. So you can see with your eyes we are in a divergence. We're forming each one of these impulses to the upside has actually less strength behind. Okay, so at some points this will break to either direction. If it, depending on the zone, is going to meet in the zone. Okay, another example we have as we speak, dollar franc on the dailies forming a channel. Okay, you can see how we had this supply right here. Okay, this impulse to the downside, we retested it. Okay, we pull back. We haven't retested all the zone, but we have immediately another impulse to the downside. We retested. Impulse to the downside, retested. So this might break to either side depending on what we meet, on the left. And if we throw another indicator, we can see this is the same chart. That's the euro dollar franc on the dailies. We see the compression on the charts, and you can throw, RSI, MACD, stochastic, whatever you want, and you will see the divergence. You will see you're actually having inverse momentum regarding your indicators. I don't use the indicators personally because I see the divergence with my eyes, but if you're just starting out and you have doubt, well, is this a compression, is this a weak movement, whatever it is, you can throw an indicator to give you extra confirmation. That's perfectly right. And once you identify that, now we need to go into the setup, okay? So we already identify what is a strong area, okay, our Goliath, what's a strong key zone, either demand or either supply area, and we identify what's a weak movement. Who is our David in the story? Our David is the compression, these weak channels, okay, forming a balanced channel either to the upside or to the downside, but where across it all supply and demand is consumed. So the setup is a compression, okay? These weak channels we're speaking about, approaching a supply or demand area, and we have no high impact news scheduled at the time where the channel is approaching that demand, okay? Because the high impact news might cause breakouts to either side. But if you have this setup, you see this channel approaching one of those demand or supply areas, we want to take advantage of that. How are we going to do it? We're going to look at it right now. Markets to trade. Okay, I'm a Forex trader. I invest in other in other markets, but my expertise of daily trading is in the Forex market. So the Forex market has it's a very liquid. It has a lot of liquidity, so it's very good for this kind of setup. But you can use also, of course, on indices, and you can use it on large liquidity stocks as well. Okay, and the time frames, I mentioned that if you want to take daily opportunities, you might have to go to lower time frames, such as the 1 minute, 5 minute, up to 1 hour probably. But it's fine also to use it on the higher time frames, 4 hour or daily. You will have less opportunities. Okay, so the setup is we want to take advantage of these movements. How are we going to do it? Our entry signal. Okay, there's going to be no confirmation. We just want to take the opposite trade. Okay, as the channel is approaching the area. I don't want to see any kind of pin bar or bear confirmation candlestick or stuff like that. I don't want that. I just want to take advantage. As the channel is entering the area, I just want to sell or I just want to buy, depending on the direction. I'll show you in a minute how I'm going to enter the trade. If I'm off the screen, you will need to use limit orders. You can just set your sell limit or buy limit orders when you see the channel approaching. And if you're in front of the chart, of course, the best is to use market orders and just to enter in and out of the trade. So let's see some examples, okay? We have right here, you can see this movement right here just exploding. We have a little consolidation and explosion to a breakout to the upside. we have whatever we had here, and then we have a channel, okay? Look at the channel we have here. So we have little impulse, retest, little impulse, retest, little impulse. And as the channel enters the demand area, we see the reaction, okay? Reaction to the upside. That's the same chart I had before. Let's look at other examples. Dollar, Japanese yen, that's the 1 minute chart. We have this downtrend, okay? So we have the impulse, pullback, impulse, pullback, impulse, okay? All these impulses are supply areas, okay? We have a supply area up here, a supply area up here, a supply area up here. Now in this case, see how after this pullback or this impulse to the downside, we have the channel, okay? Look at this balance movement, a weak movement. Up and down, up and down, up and down, up and down, up and down. And as we approach the mid-range supply area, we have the next movement down, okay? Potentially, we could be shorting all these supply areas. Just the strategy I'm just presenting you, we need the two movements together, okay? We need the supply or demand area, and I want to see how the market approaches that market, okay? What I'm looking for is the market approaching in a channel, in a weak way, okay? The David approaches the Goliath, okay? And then I want to short that movement. How do I do that? Stop loss target. My stop loss is going to be above supply area or demand or below the demand area. My take profit is going to be, you will have to play around with this, but it needs to be before the last support or resistance, okay? At the next support or resistance area. Let me show you some examples. So we have the impulse, okay? It's the same chart we just saw. We have the mid-range supply. We have the movement to the downside. We have the channel forming to the upside, okay? And we said, as we approach the demand area, the supply area, I enter the market. My stop loss needs to be above the area I drew, okay? We see the last tick right here. So my stop loss needs to be above that. And my take profit needs to be at next support available. So if we were seeing this real time, okay, if I don't have all this area here, as I'm approaching my next pivot or support area, okay, previous pivot point or support, that's my take profit area. And that's why I have this risk to that return. It's a 2.2 risk reward for this setup, okay? Another example. Let's back test or see what happened here. We have this impulse and then the continuation of that impulse. So we have two supply areas, okay? Two supply areas. We could be trading both of them. So we draw, okay, that supply area and that supply area, and then we have the channel. Look at this channel. Okay, you see all across the channel how we're forming demand areas and we're retesting. Okay, we have this demand area, testing, demand, test, demand, and going upward. So in this case, we could be shorting at this area or at this area. We could be placing, okay, our stop losses above this area or above this area. And as we enter the area, we need to short. If we're going to go more advanced, we can split our risk in cases like this, where I have two valid entry points. You will see me doing this a lot in my training rooms. I will split my risk, okay? I will enter half my position at this supply area and then half that position at this supply area. All my stop losses need to be above the supply area. And then I wait for the reaction, okay? My take profit area needs to be at next support, which is previous low. One more example. We have this large sideways movement, consolidation, and then we have the break to the downside. In a gap like that, in the Forex market, that's the British against the Japanese yen, I assume there was some kind of news back then. So we had that breakout to the downside with a gap, okay? Now, first thing I do is I mark that area as a supply area. I want to be short in the market in case the market returns to that area as a channel, okay, as a weak movement, in a weak way. What happens next? Weak movement, okay? The market doesn't go straight up, doesn't go strongly to the upside. It goes very, very slow. So it forms a little demand, retested. Forms a little movement to the upside. There's a lot of retest of demand. Demand is being consumed all across that area. And what I expect from this scenario, from this setup, is that the sellers will be active once again, and they will push the market to the downside. So what happened next? I want to enter the trade. We said no. I don't want confirmation. I don't want candlestick patterns. I don't want anything. Okay. I just want to sell the market. So I could sell these levels. Any of these areas is a good selling area. I need to place my stop above the supply area. In this case, because we have a little bit more price action back here, would be a valid stop loss also at the top. But if you place it here, it's also right. I'm just hoping that the sellers will sell once again. Where are my take profits? Okay, and this is a little bit of practice, but we have a support area right here. Okay, we have support, untested support right here. We have a little demand area that we haven't tested, which is a valid take profit area, and we have the largest or the last pivot point, which is also a take profit area. So if you want to scalp these, you just take your profits here. You will have I guess a one-to-one reward area. If you want to try to squeeze it a little bit more, you go to your next take profit. And if you want to try to swing it a little bit more, you will have to go to the bottom target. And let's see how that goes. Okay, so we said at any point, okay, where the channel entered the supply area, and then we see the movement. Okay, we see the explosion. Okay, the reaction from the supply area. And we see the first target would have easily taken. That would be the easy target. And that's why myself, for my personality, scalping is the easiest way to go. Okay, it suits my personality of not holding a lot of time the trades on. So I just take profits and repeat, take profits and repeat. If we have taken our take profits at the second area, not sure. Okay, depends on the discretion you had. Not sure if you have taken profits, but you see how we did test that demand area, and then we reacted from there. If you have placed your take profit at the bottom area, price didn't get there before going back to the supply area. But first and second targets are achievable. The risk management and trade management for these setups. Ideally, you don't want to go on a full setup. Okay, so if I go back to this example, where I had two valid entry points, you don't want to go 1% here and 1% here. You want to split that and maybe risk 0.5% here and another 0.5% risk here. But as a whole setup, as a whole valid setup, you don't want to risk more than 1% in a setup like this. In this case, where I only have one entry point, valid entry point, so inside the supply area, I want to risk my full 1%. Okay. Let's move on. Now, how we're going to manage the trade? If the trade goes in your favor, of course, is it's the fun part and it's the easy part. And the good thing about this strategy is that you will have a very high win rate. Okay, you will have a sometimes one-to-one risk reward, slightly negative in sometimes. But you will have a 70% win rate, which is wonderful. Okay, so many times you will have the trade going in your favor at first. So you can do many things. You can trail your stop when an impulse is confirmed. Let's go back. Okay, so if we had this impulse to the downside, you can choose to trail your stop from your initial stop. You could bring it lower to this area right here. Once you have a confirmation that that's a pivot point. Okay, that's a turn, okay, an established turn in the market. So if it goes in your favor, you can trail your stop, you can take full profit, which is usually what I do, and discretion to extend your profit. Okay, so we mentioned that if you see the market is going aggressively in your favor, you want to not scalp, but you want to choose to swing that trade because you might have more room to profit. But that's up to you guys. That's if it goes in your favor. If it goes against you, first mentally you need to be prepared for that because all this area, it's a valid area. So if you enter at the very bottom of the area, you need to be prepared to have a drawdown inside that area. So if the trade goes against you, but your setup or your area is still valid, you just need to remember that and not to panic. Okay, that's very, very important. If it goes against you, so first calm down. As long as you're good, your setup is still valid, hasn't been invalidated. You can use discretion to scale out. Okay, if we had this example with two valid entry areas, and we decided to risk 0.5% here, and we see there's no reaction, okay, and market just continues strongly to the upside. You wanna take that partial loss, and this is very important. And you see me doing this frequently in my trading rooms. Most traders, what are they doing? They're hurrying to take partial profits. Okay, they scale of the trades when they are profiting, but they never do that when a trade is going against you. So this is key, guys, when to improving your statistic, to start taking partial losses. Okay, stop taking partial profits and full losses. Start changing your habits into a habit when you start taking partial losses and full profits. Okay, and that would make wonders for your statistics. So if it goes in your favor and you see the reaction is not there, sellers or buyers are not active as you expected, start taking some of the losses out. You will save yourself money, and of course take the loss. Okay, don't try to revenge trade up against, or pull your stop loss higher or whatever it is. If it didn't work, you will have a high win rate with this specific setup. But those 3 times out of 10 that it goes against you, recognize those, take the loss. It's all good. Leave another day. So let's try to recap a little bit. We want to start training our eyes to identify 2 things. We want to identify strong disconnections of price from a certain area, leaving behind what is called a supply or demand area, a key area of interest, where in the future buyers and sellers will be willing to be active again. So we want to identify those strong areas, and we want to identify the weak movement, our Davids, okay, our weak movements, our channels, our compressions, and our setup will be those weak channels approaching those strong areas. Once we see that, we just enter without confirmation against the channel. We set our stop loss above or below the key area, and our take profit will be at the next support or resistance available. Okay, so in our history, in our story, in our setup, most of the times Goliath, our strong areas, will smash. Okay, will defeat the weak movements. Little bit about the 5ers, guys. We're a company being around since 2016, being funded thousands of traders, and we're very glad and very happy with all the traders that trust us and work with us, and it's a mutual collaboration, and we're very glad for that. And as we finish the end, what we approach the end of the year, of course, thank you guys for being around and being part of this great community. And guys, I'm looking forward to meeting you on our big event, Traders Day Live. Go see that the website. If you're in UK, that's a no-brainer, guys. It's going to be massive, packed with content. We're bringing top, world and highest tier of expert and trainers and coaches, and we're bringing, very good traders to teach you and to train you on a day that's going to be dedicated to trading and to education. No selling, no promotion, no packed with brokers trying to sell you anything. Okay, it's going to be purely education, and I'm going to take you deeper into my strategy and into my routine and how to master the scalping strategies when you break your trades. Okay, you will see me in my training rooms breaking into my trades, scaling in, scaling out. So I'll be covering that in depth in June. So if you're in the UK, no brainer, guys. I really want to see you there. If you're in Europe, would be worth to make the effort to take a train or a flight or whatever it is to make it. If you're far away, we'll have another opportunity to do that. So yeah, that's it for me.
Wonderful.
Yeah.
So, thanks so much, buddy.
Thank you.
It's great. Hey guys, again, wonderful presentation. I loved it like always. And the guys at home also, they were writing, typing
questions.
Also the questions, yeah.
Yeah, let's tackle those.
Yeah, so let's do that. So mainly they're talking about the risk-reward type of thing, right? Because as a trader, there are two main things that are very appealing to you. One is what is the risk-reward, and the other one, the win rate.
The win rate.
Exactly. So give something about that.
Yeah. So in theory, Michael and traders, it's very important to understand this. In theory, you want to have a strategy with very high win rate and very high risk reward. In practice, doesn't work like that, okay? Right. Especially if you're scalping and the kind of strategy I just present you, you will have a very high win rate, which is good because many times you will have that feedback from the market that you're doing right and the market is going in your favor and you will be banking profits, but you will not making a lot of money on each trade, okay? You will have a break-even risk-reward strategy or setup. But that high win rate will compensate for the break-even or slightly negative risk-reward you're having. So, you know, it's always personality and it's the technique you're using. If you wanna be a position trader or a swing trader, you might have the opposite. You might have a very large risk-reward. Right. And a low win rate. Okay, but it's all good. It's for me it works fine because I'm not very patient. I just want to bank profits, and then to do that same activity again and again.
So you basically need to find your personality in the trading in order to understand if you want to hold it a little bit longer or just have a better risk reward.
Yeah. For me, it was at first it was very challenging. It was very challenging for me because I was getting these messages that you wanna hold your trades longer and let your winnings run and cut your losses short, okay? But then I realized that's not for me, okay? It doesn't work for me. I'm struggling to let my winnings run. So I need to bank profits and scalp and bank profits and do that many times instead of just trying to make one trade that will give me a lot of profit. Okay?
Gotcha.
So you just need to adapt that to your...
Yeah, definitely makes sense. Let me see if I kind of gathered or combined those questions. We do have a question regarding the supply and demand of how do you know if it's valid? I'm not sure if it's on this presentation or maybe Gil's, but basically how do you know if it's valid or...
It's a good area. It's a good question, and later on Gil will be covering more in the supply and demand areas. But basically, to be a good tradable area, you want to see price disconnected aggressively from that area and not coming back, soon. You want to see price going, breaking and continuing, following through after the breakout, and of course not being tested until you're set up the trade you wanna see. So if it has been tested already, you don't want to take that trade.
Okay. And what about a guy here is asking about the rules of opening a trade? Basically, is there a set of rules, a 1, 2, 3 action plan?
Not really. It's very straightforward, guys. When you market already, and you're not going to be, masters and perfect at the first time. You will need to, to practice this and to refine how you mark your areas. But as the compression, as the channel enters the area you mark, you want to take the trade. Okay? There's no hesitating. I want to see an indicator tell me when to enter, a candlestick pattern, whatever it is. You just want to
just dive in as soon as
market sell or market buy.
Gotcha. Okay, that sounds great. Of course, if you have other questions for Saul, just drop them through our email, help@the5ers.com. So just before we will go through the question you have, the riddle that you have for the raffle, let me remind you guys, we are hosting a raffle, a huge raffle. At the end of each presentation, the presenter is asking you a question. If you get the correct answer, you get into the raffle and potentially win 6 tickets to our live event in the UK and also 12 evaluation accounts to trade on our capital. So in case you missed the previous presentations, just go back, listen to them, listen to the question and answer it through the link that we are sharing right now at in the chat box. So click on the link and answer Saul's question. Saul, what is your question?
Yeah, and thank you for that, Michael, because it's not like the first one who sends the answer gets it right or gets the ticket. All those who...
It's a raffle.
Yeah, it's a raffle from those who answer correctly. So make sure you take the time. This is an open question, and there's, you need to type your answer based on what you heard from me, and then from those who get it right, we will raffle the prize. So my question is, why compressions? Why these channels are considered weak movements in terms of supply and demand? What happens in that channels that make them weak?
Okay,
That's
sounds good.
That's the
Hopefully you get the answer correctly. Just before we go on a break, let me explain what is going to be next. Yaniv, our Mother Teresa, as we like to call it here in the office, the guy who can get us any snack bar that we like, is gonna perform his own presentation about top-notch strategy using EMAs, exponential moving averages. So we have roughly like 20 minutes that you can take the break, and after that we will continue our event here. Besides that, if you want, you have also a link in the chat box if you want to get and download all the PDFs of our presentations. So you can go click on the link, drop your name and email, and you will get it through your email, the full PDF for our presentation. So we'll see you in 20 minutes. Bye for now.
Thank you, guys.
עבדתי בשבילכם, בגללכם, בשבילכם.
What a terrible coffee. Whatever. Okay, guys, we are back. An amazing event so far. I'm super excited and I'm glad you like it. I see the comment that you live in throughout the presentation, so it's great. In case you just joined us and you just woke up, let's say if you're living in the US, so we're having an amazing event, live event, a marathon, and basically we already had 3 incredible presentations from Jordon and Saul and Ruben, of course. In case you missed that, you can go back and watch them. Make sure you watch them because we're also having a raffle. So at the end of each presentation, the presenter will ask you a question. If you get the correct answer, you can join a raffle and potentially win 6 tickets to our live event in the upcoming summer in London, UK, yes, and also 12 evaluation accounts to trade our capital. So our next presenter is an amazing guy, the one that actually brought me here to the 5ers and trade a pool. Please welcome Yaniv.
Hey Mickey.
How's it going?
Thank you. Great.
Yeah.
Hey guys, great to be here.
Are you ready for it?
I am.
Okay. You know that I didn't make any joke.
Yeah, well, how come you skipped the joke on me?
I mean,
About me.
you're the one that buying me the vegan cheese, so I gotta keep it okay
Yeah.
with you.
Okay, well,
Alrighty.
I'll keep getting you the cheese then.
Enjoy it, guys.
All right.
We'll see you next time.
Hey guys, thank you. Thank you for joining, and I'm glad to be here. My strategy today, well, the title is Sit Tight, but basically it's about confluence and confirmation. It's a simple strategy, and sit tight is basically relevant for any strategy. You have to wait patiently for the strategy, thank you, for the strategy to, for the chart to show you the signs, and I will put an emphasis about that. Let's talk about a little bit about me, about myself. Chief Operation Officer at the 5ers and Trade the Pool. I'm in charge of technology, risk management, the operations here, feeding the guys as well. I'm an avid technical analyst, so I love analyzing charts. I make a lot of money theoretically when I analyze the charts. When it comes to trading, a little bit less than that. You know, psychological aspect is a whole different thing. And I've been day trading pretty much since 2008, just before the big crash, when euro-dollar was still 160 and Tesla wasn't even trading and Bitcoin was probably a cent or something like that, I don't know. A lot has changed in the market since then, but one thing hasn't changed. They always provide you with great opportunities. You just have to wait and look for them. You never miss an opportunity because new ones always come. The strategy I'm about to show you is a simple strategy, really. There is no holy grail here. It's really simple, but I'll put in more time and emphasis on the risk management part and the mentality part. This strategy specifically works best for me because of my character, because I'm busy, and always when you pick up your strategy, it's important that it fits you. I mean, there are endless strategies in the market. You can trade the financial markets in infinite ways, so you need to pick up the one that fits you the best. A little bit about the strategy, a short preview. Basically, this strategy is a trend following strategy. I have other strategies that are counter trend or not necessarily with a trend, but this one specifically works with a trend, and I love working or trading with the trend. Usually it's easier, and you know, just like wave surfing, you surf with the waves, not against them. It's suitable for day traders, intraday, for swing traders, for long-term traders, and basically in terms of the time frames on the chart, You can trade it from 1 minute to 1 month. I think usually best charts are anywhere between the 15-minute chart or the 5-minute chart and the daily chart. Again, depending on the time frames you like to trade. Alerts are a good way to use the strategy, setting up alerts. This way you don't have to spend too much time on watching the charts. As I said, I'm busy. I don't have a lot of time to stare at the charts. I don't have the patience to stare at the charts. I have the patience to wait for the signals and for the chart to evolve, not staring at the chart, because if you sit staring at the chart all the time, eventually you will take trades that are unnecessary. You will overtrade just because you're sitting and you feel like you have to take a trade, even though there's no signal, and the setup is not right for you. So a great way to avoid this is to use alerts, and I'll show you exactly where. And patience is the top skill, I think, for any strategy, especially for this one. Just wait patiently for the confluence, for the signals to come together. We'll discuss it in the next few minutes. 4 parts to this strategy or this presentation. We'll talk a little bit about static zones and dynamic zones. This is the simple, the basic stuff, the basic part. Confirmation with price action and the confluence. And of course, a little bit about setting your stop losses or risk and your targets or take profit. You don't need much for the strategy. Again, it's super simple. Naked charts. So you take a naked chart, you add some tools, some drawing tools, rectangles, horizontal lines, maybe a little bit of diagonal lines, but basically the drawing tools are simple rectangles and lines. You use the indicators, the exponential moving averages, and I'll speak about which moving averages these are. Multi-time frame analysis. You will need to move between time frames just to analyze and draw the zones, the lines, and to see the moving averages. But other than that, you use one time frame, your favorite time frame, or the time frame on which you see the signals, the entry signals, is one time frame, but you analyze on multiple time frames. And as I mentioned, another tool is just an alert, just setting up the alert so that when the price reaches the level, the zone that you think is the right zone to enter, you get the alert. This way you don't have to stare at the chart all the time. So 4 parts. The first 2 are simple, are basic. I'll go through them relatively quickly, and I'll focus on number 3 and 4, confluence and confirmation, and of course, risk management and mentality. Static zones, these are the basic, and they've been mentioned throughout some of the presentations here. We're talking about identifying where the sellers and the buyers are waiting or entering or collecting their stocks, their currencies, whatever. These are the big supply and demand zones or the support and resistance areas. You draw these significant zones across or in some of the time frames you choose, and you keep them on the chart. Simple, it doesn't take a lot of time, straightforward. You start with a higher time frame. So let's say you're a day trader, you trade intraday on 5-minute charts. You can start with the 1-hour chart, go down to the 15-minute chart, and then 5-minute chart. If you are a swing trader, you trade, let's say, the 4-hour charts. You can start with the weekly chart, daily chart, and then 4 hours, and so on. So you always start with the higher time frames. You draw the supply and demand zones on these high time frames, and the same for support and resistance lines. How do you find these supply and demand zones, you look for the places where big moves were initiated, or where big moves started in the chart. Saul also mentioned it. You start drawing the rectangles around the areas, and I'll show you some examples in a minute, where the big trends started. These are the places where a lot of buyers came in or a lot of sellers came in. The zone is an area where usually there is accumulation or distribution. Buyers come in, collect, or sellers come in and start selling. And eventually the big moves start from there, and it takes them a long time to go back to that zone. So these are significant zones with a lot of big institutions, banks, and a lot of buyers or sellers are interested around these areas before the price starts moving in a trend. And a lot of time, the market goes sideways. These are the areas where usually the supply and demand zones are created. You will see usually around these areas also price action, big candles, engulfing candles, or morning stars, things like that, shooting stars, dojis, spinning tops. For example, on a daily chart, you'll see many candles moving sideways. On the monthly chart, it will be one big candle in the form of a spinning top or a doji or something like that. Okay, so price action, again, depending on the time frame you're looking, and many times the price comes into these zones or stays around these zones in compression, or again in the form of accumulation or distribution. So for example, euro-dollar weekly chart, you can see here at the bottom the area where price is moving sideways, accumulating, and eventually shooting up in a strong move all the way up to the area where previously sellers came in and dropped the price, even retested it. So from demand to supply, from supply all the way back, maybe a couple of years or something like that, came all the way back down to demand. And again, big candles, big moves, engulfing candles, a lot of strong candles showing sellers coming in strongly or buyers coming in, and the price goes up again, shooting up again, not coming back to the zone, just going up again into the supply zone again. So from demand to supply, from supply to demand, this is how big moves, this is how the market behaves. Eventually, obviously, supply and demand zones do get consumed and the price continues, but it can take years. Of course, it can take days or hours, depending on the time frame you're watching. And then you drew the big zones, the big supply and demand zones or support and resistance lines on the higher time frame. You go down, let's say from the weekly chart to the daily chart. You start drawing other zones that you see. For example, here there's an area of support or demand. And then you go even further down, higher resolution to, in this case, to the 4-hour chart, and you just draw the zones. At the moment, I'm not talking about whether you should enter or where you should enter or how do you time your entry. I'm just talking about drawing the zones in order to get a clear picture and wait for the confluence of signals about where to enter. This is, for example, Microsoft 1-hour chart. You can see here there's sort of supply, price is coming and going down again and going down again, big candles, engulfing candles. You see the sellers coming in. Eventually there's a big gap up and this supply zone turns into sort of demand, or the resistance line at the top becomes support. And you can see the price shooting up from this demand zone or the support line up. And again, you draw the zones and go down to lower time frames from 1 hour to 15 minutes, from 15 minutes to 5 minutes, and you just add these lines, support and resistance, or supply and demand zones. And this is basically the first part, the static zones of supply and demand or support and resistance. This is the only part where you should keep updating the chart with your drawings. You have to put the work and the time to analyze in multi-time frame analysis, to analyze the charts and keep these lines as long as they're relevant, as long as the price is found more or less around them. Now, this is obviously hindsight, so there may be lots of areas, lots of lines, but if the price is far away from these areas, you can delete them. You don't have to keep your chart full of lines and zones. So this is first part, static zones. It was, I think, simple, and of course, if you're not sure how to draw these zones or where to draw them or exactly how to trace them, you can always ask us, send us questions, and we will be happy to explain more. And there are YouTube examples or videos, and you have also blogs on our website. So plenty of material and explanations about supply and demand. The second part of the strategy is the dynamic zones. So dynamic zones are about basically moving averages, and this is very simple. I'll show you exactly which ones, but moving averages serve as dynamic supply and demand, not exactly well, I would say support and resistance. When the momentum is strong, when there's good momentum, good trend, moving averages tend to serve as dynamic support and resistance. So obviously dynamic because they're moving averages. And it's very simple. You just add them to the chart and they keep updating all the time, unlike the static zones that you have to update manually. We have basically the option to place as many moving averages as we want, and you can change moving averages between time frames, but I usually use 2 or 3 moving averages on all time frames, which are exponential moving averages, by the way, EMAs, which are 9, 21, and 50. In this presentation, I've used only 2, 9 and 21. 50 works just as well, and I use it personally. And just one remark, you can use any moving averages you want. If 10 and 20 or 5 and 15, whatever work better for you, use them. Personally, I like these numbers. Some like, I don't know, Fibonacci numbers like 5 and 8 and 13 or 21, whatever. But you can use any moving average. The price reacts to many moving averages. Okay, if you put moving averages on the chart, you will see that the price touches or reacts to almost any number or setup of moving averages. But again, you have to pick something. And for me, these numbers work well. And I use them on all time frames, but I start, obviously, like I explained earlier, I start analyzing the chart from the higher time frames and go down to the lower time frames. Again, 2 or 3 exponential moving averages. And what I do is I start looking for areas when I have clear trend of the moving averages. Now, obviously, you can see that you can identify the trend even without moving averages, but they help in a way because they're open. There's a wide and sort of a fixed width or gap between the moving averages. And the most beautiful thing about them is that when the trend is strong and clear, these moving averages really give good support or resistance to the price, almost very accurately. Okay, so if I see, for example, an area where I start seeing the moving averages open up and the price going along the moving averages, or well, the moving averages go along the price, but they go together in an adjacent way. What I do, I go down to the lower time frame. So from 1 hour, for example, I'll go to 15 minutes and then maybe to 5 minutes. From the daily, I'll go to 4 hours and 1 hour. And I'll start looking for the areas where the price reacts very closely to the moving averages. So you can see here the price goes down, goes along the moving average, and then goes down again, goes back to the moving average and down again, back and down, back and down. Now, first of all, when the trend is strong, it starts with a shorter time, with a shorter moving average. So for example, the blue one, the blue line is the 9 EMA. It will first react to the 9 EMA. And as the trend weakens and fades, it will start reacting to the 21 EMA until eventually the EMAs will tighten, maybe start crossing each other, and the trend will fade away. But during this strong trend, you will have plenty of opportunities to look for entries and take your big chunks of the trend. You don't have to catch the trend from the beginning, and you don't have to wait until the very last moment it ends. I mean, if you take even 1/3 of the trend, the middle of the trend, you just take 1/3 of every strong trend, believe me, you will not need more than that. It's more than enough. Never try to catch, like to make a home run, to catch the entire trend. So, dollar yen, it had an amazing move. I spoke about it at the time, a few months ago. I spoke about it in the trading room. I said that once dollar yen breaks above 115, it has infinite room to go up. Basically, dollar yen, I don't know if you've noticed it, it's part of a huge reverse head and shoulders on the monthly chart. No wonder it went up so much and so aggressively. But you can see here that it starts going and the trend is starting to open up. And once there's this break above the resistance line around 115 that was moving sideways for, I don't know, about 9-10 weeks on the weekly chart, then the price started gaining momentum. The trend is gaining momentum, and the moving averages are opening up, forming exactly this formation of wide, strong, supportive channel. And then you can go down to the daily chart or the 4-hour chart and start looking for entries to the long side. Just because the weekly trend is so strong and the daily trend is strong, you can start looking for entries to the upside on the 4-hour chart. And of course, from the 4-hour chart, if you're trading shorter time frames, if the 4-hour chart has a strong trend, you can go down to the 1-hour chart. If it has a strong downtrend, you can go uptrend, sorry. You can go down to the 5-minute chart or 15-minute chart. So obviously, as long as there's a strong trend on higher time frames, you can go to lower time frames and look for the entry signals along the moving averages. Now, obviously, still, I'm not talking about the entry points here. This is just one part of the strategy. So we spoke about static zones, and these are the dynamic zones or the dynamic support and resistance. Before I move on, I just want to say something about moving averages and generally about stop loss and take profit, because this is also, managing your risk is also part of this strategy. So we spoke about static zones, we spoke about dynamic zones. Stop loss orders can be placed and should be placed always either according to the static zones or according to the dynamic zones. So if you enter the trade above a support line or a small demand zone, you can place your stop loss before entry just across or below the support line or the demand zone. If you go short, obviously you place it above the resistance or supply zone. This is one option, to use the static zones as your stop loss reference. Another option is to use the dynamic zones. So you place your stop loss across the longer EMA. If I go long, once the price hits the confluence, and I'll explain in a minute, the confluence of support in, let's say, the 9 EMA, I can place my stop loss below the 21 EMA. And if I go short around the 21 EMA, I can place my stop loss above the 50 EMA. So I always take one extra EMA, okay, from 9 to 21, from 21 to 50 or whatever, and that's the EMA I use for the dynamic stop loss. So it's sort of a trailing stop loss, but it's a smart trailing stop loss. It's not a stop loss that just goes X points or pips or whatever, lagging after the price. It's a dynamic stop loss that goes with the movement, and the fact that you're using the longer moving average gives you some room, some leeway, and of course, as I mentioned, if the price goes back to the longer stop loss, to the longer moving average and crosses it, probably the trend is weakening. But again, if you're taken out in the middle of the trend, whatever, and you see that the trend is resuming, you can always go back in again. So stop loss, always use it, of course, either statically or dynamically. If you use the static zones, you'll have to move it yourselves, and in this case, you have to keep drawing, and watching the peaks or the troughs, and drawing the support and resistance areas, and move the stop loss accordingly. As for take profit, your targets, they can be technical. So as I mentioned, the price moves from demand to supply, from supply to demand, or from support to resistance, from resistance to support. So you can always, and you should always, watch the chart and see, okay, where is the next zone to which the price could be moving. If I go long from demand or from support, I watch the chart and I see, okay, where is the next supply? Where is the next resistance? Do I have enough room to take this position? And if I do, I can place my target at the opposite zone. I can also do it with a simple calculation, meaning I don't have to wait. Maybe I don't have patience. Maybe I'm not sure it will reach or hit the next zone, the opposite zone. But I say, okay, my strategy requires at least, because of, I don't know, the win ratio, it requires at least a risk-reward ratio of 1 to 2 or 1 to 3. So I see if, let's say I have a stop loss of 1R, if I have enough room for the price to go 2R or 3R, okay, and then I place the target there, maybe the price will go even further after my 2R or 3R are hit, but for my strategy, this is what I need to take. You just, again, have to make sure and analyze the chart that the price has enough room to go to the other direction. Okay, these were the two simple parts. Now we start combining and bringing things together. So I'll talk about confluence and confirmation. Jess Livermore, a very famous trader, said money is made by sitting, not trading. Okay, most of the time you have to sit and wait for the signal to enter, sit and wait for the trade to evolve, for the profit to run. Sit and wait until you have a reason to click the mouse, okay? Clicking the mouse, trading itself doesn't take a long time. Sitting is what you need to do, and that's why it's hard for most traders, especially nowadays when everyone wants to to see things fast, to see the results fast, but you have to sit and wait, sit tight. So this strategy, as I said, is simple. You have static zones, you have dynamic zones. Now we want to enter at the confluence of the static and dynamic zones, mostly the moving averages and the support or resistance lines that you drew. Once the price reaches these confluence zones, and I'll show you a few examples, you can see them on any time frame, but once you see the confluence of these, once the price comes back to this confluence of zones, you have much more confidence in the trade. Okay, you know that, okay, I have at least 2 signals or 2 support areas or 2 resistance areas. It gives you more confidence. And then if you have more confidence in your trade, you will probably let the trade run. You will probably let it, make its move. You will not be hesitant. You will not be in a hurry to take your profits fast. So it gives you more confidence. It makes your trades healthier and more professional. Price action gives you higher chances. In price action, I mean candle formations or candle patterns. So price action means what is the price doing around this confluence zone? How is it reacting? Is it forming a doji, a pin bar, a spinning top, an engulfing candle, or maybe patterns like a pennant or a flag coming into the moving average and into the zone adjacent to the moving average in the zone, sort of compressing and then breaking out. So this price action is your confirmation. So you have confluence and you have confirmation. And if you wait for confluence and price action, you will have much higher chances for the trade to be profitable. And then, of course, you have to decide how patient are you. You have 3 entry options. The first one is at retest. So let's say the price goes up, there's let's say a support line, the moving average moves up, and then the price comes back right at the point of confluence of support line and moving average, which is also a dynamic support. So in option A, retest, once the price hits the support line, if you're impatient or if you feel confident enough or whatever, or you want to, you don't want to miss the opportunity, and you start by taking a test trade, okay, or an initial small trade. You can start there. I put the bell here to remind you that you don't have to stare at the chart and wait for the price to return to this support line. Once you have the support line and the price goes above it and you see the trend, if the price comes back there, you can place in advance, you can place an alert, and once the alert turns on, you can then go and enter the trade. Second option is at close. Okay, so sorry, the close of the candle. In this case, I'm waiting for the candle to close to show me that there is some price action, for example, a pin bar. Again, more confidence. And the third option is not only to wait for the closing candle, but to wait for a breakout above or below the confirmation candle. Okay, and this gives me the highest confidence. But again, you can decide according to your patience and your skill. So an example for our chart on Facebook Meta, okay, support line breaking down and starting to retest right around the moving averages. And here's sort of a pennant into the 21 EMA and going down. And of course, if I go down to the 1 hour chart, and I see that it breaks below these lines, I can place an alert, and once it comes back to the line, I go in. Okay, or for example, gold. Okay, I see the gold coming up from this support line, strong engulfing candle, moving up, and once I realize there's some sort of an uptrend evolving and even a breakout and a retest on the daily chart with some spinning top, I can start going to the lower time frame and entering around, again, around the moving averages and the support lines with the pin bars or dojis or engulfing candles. Again, confluence, support or resistance, moving averages, and price action. This is from yesterday evening. Okay, yesterday evening or yesterday morning for the Americans among you. Support line on the 5-minute chart on the S&P futures, breaking below, going higher, or retesting the support line and the moving average, in this case 21, breaking down. And again, testing. There's also sort of a minor support line or resistance line here, testing the resistance line from below and breaking down again. Same for NASDAQ futures on the 5-minute chart. So this is basically the strategy. Not complicated, requires you to wait patiently for everything to be in confluence. Warren Buffett said the stock market is a device for transferring money from the impatient to the patient. Again, patience is key no matter what strategy you choose. Very quickly, I'll go over some things. And by the way, everything is written. These slides are a summary of everything that I wrote on the slides that you get in PDF. Everything is written there with more elaboration. Always use a stop loss. I don't need to tell you much about it. First determine where you place your stop loss technically on the chart. Only then set your position size according to the risk you're willing to take. So you place the stop loss, you know you're risking, 0.5%. You make the calculation of the lot size or the position size or the number of stocks, and you enter only then. I can't emphasize enough the next sentence. Be sure you're completely comfortable with the risk. If you're not comfortable with the risk you're taking, do not take the trade. Because if you're not comfortable with the risk, you think you're risking too much, you will move the stop loss, you will remove the stop loss, you will do things that are unprofessional and eventually will make you lose more money than you planned. So be sure to completely be comfortable with the risk, and remember to think on a series of trades basis, meaning there's not just one trade that everything depends on. Okay, each trade is a part of a series of trades, and it's all about statistics. If your strategy works 60% of the time, obviously you're going to lose 40% of the time. So don't put too much emphasis on any one trade. Think on a series of trades basis. Remember to look left at the history of the chart. Be patient. Don't chase the market. There are always opportunities, endless opportunities. And wait for the good trades to pop out of the chart to tell you, take me. Okay? Don't take trades just because you're sitting in front of the computer and you feel like if you're not trading, you're missing out or not doing enough. You can log your trades in a trading journal, but eventually your purpose, your goal as a trader is to be consistent and to improve yourself and to focus on the process, not to make money instantly. Yes, you can make $10,000 in one trade, but will you be able to do it for a long time? Will you be able to remain consistent? That's it. I hope you will join me and everyone else we're bringing to London in June, June 17th, in the center of London. It will be an amazing day with lots of highly experienced traders and lecturers. So we're all looking forward to seeing you there. Thank you very much for being with me. Michael?
Yeah, thanks so
Yeah.
much, Yaniv.
You're welcome.
That was
Thank you.
great.
Thank you.
Great presentation. And I love the fact that you talked about the supply and demand, building the presentation for Gil as well. So that was incredible.
Thank you.
Saul, can you grab me please my iPhone, because I forgot to take it with me. And we will read some questions.
Okay.
There's good questions regarding your presentation. Thanks so much, buddy. And let me have a look. So the first question for you, that's an interesting one. Why do you take profits early on a fade trade? A fade play, basically, right? So the guy is asking, why do you take profit fast when it comes to a fade strategy?
Again, I'm not sure it's a fade strategy. Basically, I'm taking profits either because they hit the stop loss, or because they hit my risk-reward ratio that I set in advance, or the next zone. It can move further away from that, but I set the targets in advance. I don't think I'm taking the profits too fast.
Too fast?
No.
Okay. What about, you said that you're a trend trader, so how long do you hold your trades mostly? Most of the time?
With this, that's what I said. This strategy is very straightforward and very simple. I hold the trade as long as it doesn't hit the stop loss, which I move with the moving averages,
right,
or until it hits the target, which is at the next zone, the opposite zone. So if I start at demand, I will close at supply if I see that it starts, holding or maybe fading, or if I hit my risk-reward ratio. If I know that my strategy works well with 1 to 3, like 1 to 3 or 1 to 4 or 1 to 1, 1 to 2, then I will take my profit there. But it's not that I decide in the middle of the trade, okay, that's enough.
Okay.
Okay, I either trail my stop with a moving average or hit the opposite zone.
Right.
And maybe see a signal that gives me an indication. Let's say at supply zone, I see, the same signal that I get at demand, but for sell. Okay, so a spinning top at supply will tell me maybe now it's time to start looking for sell, and I will not remain at my long position.
So speaking of spinning top, one of the guys here is asking your favorite confirmation, candle or pattern.
So my favorite confirmation, my favorite confirmation candle is the pin bar.
Okay.
For the upside, or the shooting star, let's say, for the downside. But doji is just as great. I would say that the engulfing candle is strong, but it just moves me too far away from the entry point.
Yeah, the risk reward.
Yeah, exactly. The risk reward is a bit shaky, and I want to remain relatively close to the confluence zone.
Okay.
So that's why I prefer the smaller candles, like doji, spinning top, pin bar.
Makes sense. And which entry options do you prefer the most? Retest, close, a breakthrough?
Personally, the close. So once I get the price confirmation, I go in. Okay, the retest is too soon, too fast, and the breakout above the high of the previous candle might again take me a little bit too far away from the entry point, or it changes my risk reward. So option B for me is the favorite.
Okay, gotcha. Great. Again, guys, if you have more questions, feel free to drop them through our email, help@the5ers.com. And just before Yaniv will tell you about his question regarding the raffle that we're hosting, you will have a link in the chat box. Click on that link, answer the question that Yaniv will ask you in a second, and then the one who will get it correctly will get into the raffle. So Yaniv?
Yes. So my question is a simple one. How many red apples were there in my presentation? Nothing too sophisticated, but there were some red apples and green apples and bells. So how many red apples were there in the presentation?
Okay, of course you need to go back now, watch it, and then answer it. That's a great question, Yaniv. Click on the link in the chat box in order to answer, and then you will potentially get into the raffle if you get it right, and will be able to win some amazing prizes. Like Yaniv just mentioned, we are hosting a live event in London, UK in the upcoming summer, and also 12 evaluation accounts that you can actually trade on our capital instead of risking your own. That's it. Great. Thanks so much, Yaniv.
Thank you very much.
That
Thank
was
you, guys.
amazing. And
Thank you. Enjoy the rest of the day.
yeah, now we are going on a quick and short break. After that, I will be here and present my own strategy, the way that I pick the right stock to trade with the buy the dip strategy. So quick break and we'll be here again. Bye for now.
This
And we are back. Thanks so much for staying with us, guys. I'm Michael, and right now our next presentation will be me. But you know what, now that I'm thinking of it, it's not fair that I'm the one who presented myself. So please, Saul, can you do me the honor? Okay.
Sure, Michael. Sure. How are you?
I'm great.
Excited?
Yeah, very
Excited about
much
the presentation?
So. Yeah.
So guys, you might be familiar already with Michael. Michael is our stock trader.
The only one, huh?
Yeah, the best one, might see. 15 years experience in stock trading, much to learn from him. Should I go with the vegan joke or should we skip that part?
No, we'll skip that.
Okay.
I'll let them know
Okay.
later on.
Michael,
Thanks so much.
take it from here, guys. Enjoy.
Yeah. So guys, today I'm going to talk to you about how to buy the dip, but first understanding the scanning strategy in order to apply to buying the dip. Of course, if you have any questions, feel free to drop them in the chat, and at the end of the presentation, I will answer some of them. Let me give you, of course, a quick introduction. I know that we got intimate already because I'm with you for the last 4 hours. So my name is Michael Katz. I'm the CEO of Abitbol. Abitbol is a funding stock day traders company. So we basically fund stock day traders. And let me show you a little bit my way until I reached that moment. So I started actually with this guy, a famous one, Robert Kiyosaki. I read the book of Rich Dad Poor Dad, understood that there is such thing as a stock market. And then from that point, I tried to apply my counter strike method or skills as a computer playing games, you know, to the trading market. And this is why probably I'm doing mostly day trading and not just buy and hold kind of thing, because I like to be active the same way as I was when I played those games of one-person shooter, basically. Other than that, during my 15 years of trading, I started to understand how to basically find those manipulated moments in the stock market where actually the market makers are playing with the price in order to execute for themselves better ways, to find better ways for them to execute the price. So we'll talk about that later on. And the cow is to remind you and tell you that I'm vegan as well. So if you're into that, write me in the chat box. Alrighty, before we will start, just let me get to know you just a tiny bit more. Are you a stock trader or a Forex trader? So type in the chat box, 1, if you're a stock trader, 2, if you're a Forex trader. That way I will know how to take those things that I'm about to share with you, the parameters that I'm about to share with you, to the right way, to the right market, and the right approach. In my examples, I will talk about shares or stocks because this is what I do, but you can easily take those things to Forex as well. So I'm getting a lot of 2s from Saul. 2, do I hear 1? Okay, I got 1. Some 1, some 2. I get the point. You're a Forex trader. I need to convert you to start trading stocks. So we're going to tackle this in this presentation. I'm going to tackle the strategy that I'm about to share with you in 3 different ways: the why, the what, and the how. Okay, so let's talk about that. First of all, the why. In anything you do in life, you need a reason. You need the why am I doing what I'm doing. It's basically the reason for the what. So anything you do in life, try to start from the beginning, understanding why you do the things you do, and only then go to the what and the how. Now today, hopefully, I will share with you the why, and as soon as we will talk about it, you will understand why it makes sense to do the right thing to do with this strategy. The next thing is the what. So basically, what are we doing? What is the strategy? What is it that you need to act on in order to execute it right? And of course, the how. How do you do it? So we'll talk about those three things in a second. Let's start with the why. Probably the most important thing that you want to focus on. I know that everyone likes to, just go to the how. Where's my entry? Where's my stop loss? How do I take my profit? But let's start from the beginning, because as soon as you will understand the why, you will have more sense of how to execute it, what to execute and how to execute it correctly. So in the market, we have two players. One is the smart money and the other one is the dumb money. It doesn't matter which market are you trading, it's the same concept. Either if you trade in Forex, US stocks, European stocks, whatever it is. So on the right side, or the left side, depends on where you're at right now, the smart money is basically the hedge funds, the investment banks, and the big pockets investors, right? The one who actually move in the market. On the other side, the dumb money, retail traders, general public, that's basically us, and tip lovers too. Now, in order for the market to move, we gotta have a buyer on every seller, right? You know that from the day one that you learn how to trade, from the first execution that you made. So basically, for every buy or sell from the smart money side, you will have a buy or sell from the dumb money side, right? Now, for them, for the smart money to act and actually buy, let's say, 100 million shares, they got to have us on the other side, right, in order to execute their trade. You can't really go to the mouse key and just click on 100 million shares and just buy it, market order. You can't really do that. So what they need to do is manipulating the price. They're not bad guys. They're not doing it because they, just want to harm you. It's just because they got to do it. They got to manipulate the price in order for you to sell when they want to buy, and the opposite. So when they want to sell, they need to trick you to think that this is the right moment to buy. So this is the market structure. This is how it works. It's been working like this since day one, and it will continue. Doesn't matter if we're talking about humans that click in the mouse key, or we're talking about robots, basically, that algos that move in the market that way. The same principle will stay the same way. Now, if we know that those guys, the smart money, are actually making money consistently, then of course we want to trade with them. That's it, simple as that. So this is why it makes sense to buy the dip, because when you buy the dip, you are basically buying with the institutional traders and not just buying randomly. Because if you buy with the institutional trader, your chances that this price will continue higher right now are much higher, of course, because most of the time they will make the money. Second thing why you want to buy the dip is also simple. When you enter in at the lower price, like Yaniv mentioned with the spinning top or spinning bottom or a doji, you have a bigger risk-reward ratio, and this is something that any trader wants. So, the what? Now we're talking about basically the strategy, the radar, is first to understand how to scan for the right asset to buy the dip. So we're talking about two things. First, how to find the right asset, and then how to trade it in a buy the dip mode, let's say. And this is something very important to remember. So I'll move so you can see that. Find the right asset, and the rest will follow. No matter what you trade, and this doesn't matter if you trade in EMAs, if you trade in supply and demand, if you trade in Bollinger Bands, stochastic, RSI, you name it. At the end of the day, it's all about the asset that you chose to trade. If you didn't pick the right asset, your chances are much lower. And this is probably the most important thing that you need to cover when it comes to trading. Find the right asset and the rest will follow. Now, how do we find the right asset, or what is it that we're looking for? So any good strategy will cover three things: liquidity, liquidity, and liquidity. So if you have an asset that has a lot of liquidity in it, you're already at the top. But this is a question for you guys at home. What will create liquidity? Please share in the chat box right now. Type in what will create liquidity. Now, again, doesn't matter if you trade in Forex or stocks. The concept is the same everywhere in the world. The same market, actually. Doesn't matter if you trade in financial markets or real estate market. What will create the liquidity? And Saul, what do they say in the chat? Give me some answers. Okay, news, exactly, right? What else do they write about? Of course, key levels, yeah, perfectly. So guys, exactly as you just mentioned, news and levels. Those two things, two keys, elements that basically will move any asset, a Forex pair, commodity, any share. At the end of the day, it's all about news, the sentiment, and the levels that we are in. If the price is randomly moved to whatever it is and not touching any levels, there won't be any liquidity in it. Not enough, at least, to create this manipulation that the market makers, the big money, smart money needs. The same goes to news. It comes together, actually, right? If no one talks about this type of stock, then no one really cares and no one start trading it, basically. So the same concept. So these are the things you need to watch for. News in a specific company, as you will see in a second through the examples, and also general news in the market. CPI, employment rate, ADP, whatever it is. Levels in stocks, mostly it could be gap closing. As at the moment we're reaching a gap. Supply and demand, multiple time frame. Let's say you're watching the 1H, you're watching weekly and you watch monthly, and they all correlated together. So that will bring a lot of liquidity. And major indicators. If you're using Bollinger Bands, right, as Ruben mentioned. So basically a lot of traders use those Bollinger Bands as soon as the price will go above, let's say, the upper band of the Bollinger Bands, and a lot of people are watching it and a lot of algos watching it as well, it will create this reaction of liquidity, because then there are a lot of orders coming in, buying, selling, creating a level. So let's talk about the how. You can actually find any type of asset through those channels, either websites, scanners, and watch lists. So website could be for guys of you trading stocks. You can go for finviz.com and scan for the right asset. How you do that? You're looking for liquidity, you're looking for volume, looking for major levels, looking for, of course, all the small nuances as indicators. Those kind of things will create, of course, the news. Those kind of things will create the movement in that particular stock. Scanners, either live scanners, let's say Trade Ideas, or in your trading platform, you can use that and find assets that are trading close to a specific level, let's say close of the gap, or a special indicator that reaching top or bottom, let's say like a RSI that reaching 80 or 20. So those kind of things. And watch lists, you can actually create your own watch list and go through and watch it carefully as it evolves and getting closer to a level or news coming out on a specific day. So let's look at some charts. Tesla. even if you're not trading stocks, you probably heard about the latest news in Tesla, and we're talking about Elon Musk. Tesla is hammering down, guys, right now, all the way for 415 last year, right now trading at around 115. That's an incredible move, and even if you're not trading stocks, you probably heard about it. I know Saul didn't, so this is kind of, come on, it's Tesla. Everyone should know about it. Let's look at the charts. Look at this beautiful thing. This is a specific news in a specific company, right? Tesla is hammering down because Elon Musk basically moved to Twitter. And now that he moved to Twitter, is not acting as the CEO or not managing Tesla good enough. And there's a lot of competition, and all of those things. And he just tweeted that it could go bankruptcy. So, right, price is dropping down. This is a daily chart. Price is dropping down, reaching around the level of the 136.03. That's the close of the gap from December 2020, right? So what he did, basically the price went all the way back to 133, and look what happened as soon as we reached that level. Boom. Touching it, that's an intraday chart, 1 minute chart. The price started here, that's the day, dropped down, reached all the way to the close of the gap, breached it like in 5 seconds, 5 cents, and bounced up all the way up $5. Now $5, in case you're not trading stocks, multiply that by 100 shares, that's $500. Multiply it by 1,000 shares, that's $5,000. So basically, just the tiny thing here, the close of the gap, created an incredible move. And you see the upside as well. This is a very good thing about risk-reward ratio when you come to trade buying the dip kind of strategy. So this, to give you an idea of how it usually will work when you getting into a specific asset, an important asset that already covering some news, the liquidity is already there. A lot of traders, Tesla, a lot of traders already trade in Tesla, but now, these days, because of the news, a lot more traders are coming into Tesla. And as soon as it reached the support level, the major support level closing the gap, it's basically bouncing up first. And you can take advantage of that as well. And I will tell you in a minute how you can do that and how to buy the dip. What are the parameters for that? Let's see another example, again, from the previous days on Tesla. Specific news bringing a lot of volume to the company, to the marketplace, trading Tesla. That's first, you have the liquidity, you have the news. Now, the extra liquidity comes from the weekly chart. We're looking at a weekly chart, and this is basically what you can see. That's a 420 EMA. EMA, it's the exponential moving average, and we're talking about 420. So basically, taking 420 closes of Tesla on a weekly chart and give me the average of those with a little bit of a twist because it's exponential and not simple. And basically the price reached that 122.80. That was the price for the EMA, the 420 EMA. And this is what happened as soon as it reached that. So it broke it by 20 cents and bounced up all the way $4. Now, of course, at the beginning of the day, you can maybe see it right now at home and say, wait, I can take those $4 up, but what about the down move? And that's fine, and you should do that. But right now, we are focusing on a specific way or technique to trade stocks or, again, any kind of asset that you're trading. So you can easily look for other places to start shorting it, bear flags, retest, pullbacks, whatever it is. But at the end, why I like this strategy the most is because the risk-reward ratio is much preferable to our side, because at the end you got like 20 cents stop and a bounce of $4 at the top. Obviously you won't stay the all $4. You will take partials and scale out as you scale in as well. But at the end you have a lot of more hour to your favor. And we'll touch in a minute of the parameters. We'll talk about the parameters of the buy the dip movement. So how do we do that? We understood that we have liquidity. We're looking for liquidity through news and levels. We scan the market. We use scanners, watch lists, websites. And at the end, we want to buy the dip. So let's buy it. First thing, mark the levels. So anytime that I go and find this stock, the particular asset that I want to trade with high volume, high liquidity, that I know that the market makers or big money, smart money will like to manipulate, and we will touch that in a second as well. What I do is go to that asset and basically mark those levels. It could be a close gap, as you saw in just previously on Tesla. It could be a major support level, supply, demand, all of those things that you already know. And right after me, Gil will show you his way of finding the right supply and demand and understanding it completely. So that will help you too. First, mark the levels. Then set an alert. I usually day trade, so most of the time, if I'm not doing all of those things, I will sit in front of a computer and watch the chart. But you can easily, if you're not in front of the computer all the time, you can easily set an alert. Let's say you have the 136 on Tesla, and right now it's trading at 140. You can set an alert, half of a dollar before, and then go to the computer as soon as the alert pops. Lastly, find the price action or understand it, because when market makers, when smart money is acting, they basically will create, as I mentioned before, they will create a trick. They will create a pattern on the chart most of the time. Will create a pattern on the chart to lower you in order to manipulate the price and trick you. They gotta let you know that the price should continue to the downside, and then when you believe in that, then you sell. And when you sell, they will buy. And the opposite when it goes up, right? If the price will continue higher, they will create some form of a continuation pattern, let's say a bull flag, right? Or a cup and handle, whatever it is. And then you will say, okay, that's a bull flag, I need to buy on the break. You will buy it, and they will sell you, and that will turn to be most of the time a false break, basically. So price action, understanding that. We will use a naked chart, but I will show you one indicator that I'm using, and that will be the MACD, and of course the volume. And that's probably one of the best things about trading stocks. We have volume. And now I'm selling you about stocks, right? I'm trying to seduce you to go into stocks. So volume is basically our key to understand the switch hands, the number of shares that switch in hands from buyers to sellers. As soon as we see that, it will be much easier to find those big smart money manipulation on the chart, and we will see it in a second. And as I mentioned lastly, the MACD. MACD is an indicator. You will see it below the volume, and it will also give us some hint about what is about to happen or supposed to happen. So let's take this trade I made lastly on the QQQ. The QQQ is the ETF for the S&P, the NASDAQ 100. So the 100 stocks, the technological stocks. And let's look at the charts and understand it. So the price started to decline, moving as beautifully like in a downtrend. We are in a 1 minute chart. General news in the market, the CPI that came out lately, and also Jerome Powell spoke, and all of those things pushing the price down right now. And the price declining, reaching a major indicator. As I mentioned before, you can find either by the support level, the major liquidity level, you can find it by either closing the gap, major indicator, and all of those kind of things. And basically, as we reached the major support level, in this case, it's called pivot point. We won't get into that, but this is one of the indicators that you can work with, especially when it comes to trading stocks, but also if you trade in Forex. Look what happened. Those three keys. News, dropping the price down, reaching a major support level, the indicator, the pivot point, and look at the volume coming in. Now, the reason you will see an increase in this volume is because a lot of people are selling, and from the other side, smart money is buying, okay? And this is why you want to see the volume increased when reaching the support level. That will indicate that the price is being manipulated, okay? Let's understand that. The price is dropping down. A lot of people are watching the chart, believing that the price will continue down because we're in a downtrend, so that makes sense, right? Now, the price is creating a bear flag. A bear flag, for those of you not familiar with, it's basically a continuation pattern to the downside. You have the stick, you have the consolidation, and from that moment when we break in that consolidation, it usually supposed to indicate that the price will continue down. So they create this pattern, lower you to believe that the price will continue to the downside, and as soon as you sell here, because you learn from the books or YouTube or whatever it is that you need to sell on a bear flag, as soon as you do that, they will buy. And so there's a lot of selling pressure, but at the same time, a lot of buying pressure. And this is why you have the volume coming in, high volume coming in at the bottom, right? And from that point, the price changing its direction and going up. It doesn't mean that this is the end of the road for the price and it will go up all the way, until the end of the day. It might go up and then continue to the downside. That's fair enough. There's basically the pulling back, right? So here I bought it for in multiple times, basically scaling in and then scaling out as we continue to reach resistance levels. Let's talk about Tesla, because we cannot talk about anything else in these days. So this is one trade I made lastly again. So the gray area, the gray background is basically the pre-market session, and the black area is the market, so the opening bell. So at the opening bell, the price declines strongly, super strong momentum to the downside. Usually I won't buy right at the opening because there's a lot of manipulation going on, but specifically on Tesla, I was very well prepared because of all the news that come in and so on. So price declined very strongly. I bought it right at the bottom. First entry right here, then when it popped up and basically confirmed my understanding that the price should shoot up, I bought another one and then started selling it all the way to the top, entering a resistance level basically. So price declining, reaching a major support level, news that creating this liquidity, and then shooting up and reaching those resistance levels from the pre-market that will indicate that we can sell. Let's look at some other example. LI, great news, or bad news actually, but great news in terms of a lot of liquidity coming in. So in this case, LI is a company related to the cars, the EV cars. So in this case, price is dropping majorly. This is the beginning of the day, a 1 minute chart, crashing down, reaching a major support level, news that bring on the liquidity, and look at the volume coming in at the bottom when we're reaching those support levels. As soon as we enter in that level of support in this case, volume increasing, a lot of people are looking at the chart in this point without looking into the future and watching the price dropping down majorly. So they're basically saying the price will continue to the downside because it's already declining so strongly. This is exactly the moment when the market makers want to act and create this manipulation. And as soon as you believe that the dumb money, us, believe that the price will drop more, this is the exact moment they want to take the advantage, and when you sell, they will buy and move the price higher. So this is the trick, this is the way they will operate. And as soon as you understand that this is the way the market works, then you need to start working like the market because they are the one that making the money. DASH, also amazing or bad news coming through this company lately. So first of all, we have the news. So we have liquidity. And let's talk about here the price action behavior. Look at this. A day before, okay, this is a 1 minute chart, but all of this is a day before. A day before, look what happened. The price opened with a gap down, reached a support level, broke it, and shoot right back up. Look what happened later on the same day. We reached that low, the same low of the same day, broke it, shoot right back up. Then the next day, broke the low, reached a major support level, and shoot right back up. So basically when you're analyzing it and you're looking at the price action and you see the behavior, the previous behavior a day before, 2 days before, a month before, you will start understanding what will or should at least occur when we will break the low again, especially when it comes to the close of the gap. So basically here there was a gap. You can go of course and see it on the chart, on the higher time frame. We reached that gap, closed it, and bounced right up. But not just because of the gap, and of course you can see the volume, but not just because of the close of the gap. The whole market structure, everything you just saw here, was aiming and preparing for that moment of the shoot up. So dropping down to a support level, basically accumulating the price. Every time we break the support level and a lot of people are getting in, shorting this stock, they buying as you sell it, they buying as you sell it. And again, lastly, just a few days ago, broke the support level of the previous day, shoot all the way up. So those are the parameters you want to work with in order to find the asset and to find the right moment to buy the dip. So if I'm summarizing everything, first, what are the news or what is the news that covering the specific stock or the market itself? How does the price action look? Which level and how strong it is? Are we closing the gap? Is it an indicator from a 1 minute chart or an indicator from a monthly chart? What type of indicator? And do you see increase in the volume in order to find the differences or the switching hands between the buyers and the sellers? So if you have any questions, feel free to drop them in the chat below. And hopefully Saul will join us and ask those questions. Guys, like we mentioned previously, you can join us through our live event in UK, London, UK, in the upcoming summer. I will be there as well and presenting another special technique or a special way to understanding the market and give you a little bit of my knowledge as well. So I'll be happy to see you there, and of course grab a beer after that in the nearest pub. Saul, do you have anything for us?
Yeah, Michael, that was great.
Thanks.
Thanks for sharing. We have some questions from the public, and I guess there will be some more coming in. Before we go to your question, okay? So let's answer some of this. So, you mentioned there's some confirmation you get. So you enter like without confirmation, and then you see a confirmation, and then you add it. What's the confirmation you're using?
Okay, that's a great question. So in this case, for example, in 99% of the time, I will scale into my position. So I won't go all 100% risk in one click. 99% of the time, it will be scaling in, because I don't want to risk too much at the beginning, because I don't know for sure that this is actually the bottom, right? So I need to test it. Now you can either test it full price or full risk, and then put your stop loss, get out of the trade, and then maybe test it again and again and again. Instead of that, at least this is what works for me and what I like to do. I'm entering with a small portion. So I'm entering with a small portion, and then add in as I see confirmation. In this case specifically, the confirmation is just basically the form of the morning star. You see that it's holding the button here, and then the bounce up. So as soon as it rejected from this tail, hopefully you see it at home, there's a huge tail here. So the candle was red all the way down, then bounced up again, and this is exactly where I executed. So I saw that there is a bounce. The buyers are coming in and pushing the price higher.
Okay, I think that's clear. So next question, do you use volume indicators or VWAP for stocks? If so, would you recommend those for trading Forex indices and so?
Right, that's interesting. First of all, I do use VWAP, but not in this case. A VWAP is more of a moving average base. So in case you want to trade trends, you need to, like pullbacks and so on, you need to use a VWAP for that. I'm not using the volume profile and stuff like that, but you can use them. I don't find it too much helping too much, just maybe because I usually prefer to use to look at a naked chart. In case you want to use it for Forex trading, because we're talking about volume, Jordon mentioned it in our first presentation, you don't really have volume in Forex, right? But if you go to, let's say, TradingView and look at different brokers, you will see, like an average volume that's going on. So yeah, you can take advantage of those things. I traded Forex for maybe 3 or 4 months. That was actually great time to trade, but and I use that volume in those cases to find those dips. Yeah.
All right, Michael. Personal question: are you a day trader or a swing trader, and why?
Right. So I'm a day trader 95% of the time. I mean, first of all, I like trading generally. So swing trading for me at least, just a little bit boring because you enter a trade and then you leave it and you can watch it or whatever, but most of the time you won't do anything about it. So I like to be more active. As you saw at the beginning, I used to play a lot of Counter-Strike and those kind of games. And you need to be active, you need to react in real time. So those kind of things are attracted to me. So, and you can sleep better when you're day trading and not holding a position, especially in the crazy world that we live in.
All right. Okay, how do you terminate your positions? How do you take profits? You mentioned you sold. So where's your take profit? Why? How you manage your profits?
Okay, that's a great one. I guess maybe that's my topic will be in London, but scaling in, scaling out. But basically what I do is just as price is reaching resistance in any manner, like a pre-market resistance, it could be a gap close from the upside, could be a lot of those nuances. In case we're doing that, in case the price is reaching those levels, then I'm starting to scale out of the trade. Yeah.
All right. What would you advise for a Forex trader to begin trading stocks and on a suitable platform?
Yeah, so that's kind of easy one.
An easy one, huh?
Yeah, I mean, trade a pool. This is what we do. You want to join us, start trading. You have 14-day free trial to test our platform and to start trading and see the evaluation phase, basically. As soon as you go into that and reach the goal, you will get funded 100%. If you take me back 15 years and you will present me with a program like we have in Trade a Pool, I will take it in a heartbeat. That's a no-brainer for me as a stock trader to start trading, not on my capital, with all the support that we're providing, with the system and the tools that we're providing. Seriously, it's a no-brainer.
No-brainer, huh? Okay. Do you short stocks, and can you short stocks on Trade a Pool?
Yeah, first of all, you can short anything on Trade a Pool. Anything. All those hard to borrow, all those stocks that you usually won't get through your broker platform, you can short anything in Trade a Pool. And yes, of course, I trade short stocks. Most of the time, I had like 8 years probably that I just shorted stocks and didn't even buy the dip, just selling the top. So I was waiting, the same thing, the same concept. the price would shoot up, reaching a major resistance level. Of course, the news covering and all of those things, and just shorting it through the gaps.
All right, I think we're good.
Okay.
We're good. Now,
good.
yeah, let's move on to your question. Remember, guys, we're gonna drop the link to answer Michael's question on the chat. So, yeah, let's.
So here it is. Super easy one for those of you who listen. Why do we need increased volume when it comes to when it reaching a support and resistance level? So when the volume increased, why do we need it? Why do we want to see increased in the volume? For those of you who will get it right, you will get into the raffle and potentially win 6 free tickets to our live event in UK, and also 12 evaluation accounts to trade on. That's incredible, guys.
Correct. Yeah. So you should be getting in the chat box right now the link to answer Michael's question. All of you who answer it right will get into the raffle. We'll announce the winners either later tonight during the day or tomorrow. Just we'll stay tuned. You stay tuned.
Right.
Yeah, that was great, Michael. Thank you very much.
Yeah.
Should we go into our last break?
Yeah. Last break before the end of the event. Of course, we keep you waiting for the big finale. Our own unique guy that will show his masterpiece on supply and demand. And
the other bald guy.
The other one. Yeah.
The other bald guy.
I'm not alone here.
Yeah. Okay. So yeah. Let's go into a short break, and we'll be back for our last presentation, Gil Ben-Hur.
Take care for now. Okay, guys, we are back. We reached our last hour of this event, this amazing event that we already had. Almost 6 hours. Incredible. Thanks so much for staying with us. We highly appreciate it. And we saved the best for last. So please, let me welcome Bruce Willis. Gil Ben-Hur. Thank you. How's it going, Gil?
Hi there. How's it going?
I'm great. So, Gil, take it away, enjoy it, and I'll be with you at the end with the questions.
Thank you, Michael.
All righty, good luck.
How's it going so far? We're very pleasant to see thousands of people already watch this amazing marathon. So, hello guys, and I'm happy to see so many of you joining up, piling up this holiday. We are having a very exciting marathon today, and I'm the one that's going to wrap everything. So let's start off. So here's a dilemma for you that you probably experience. You have your strategy. You practice it, you master it, you demo test it, you trade it live, you invest money in it, and now your strategy gives you the signal. What do you do with that signal? Do you take it right off when it beeps, blimps, whatever it is? Or do you wait? Do you take any confirmation manner? Let's hear it from you. What are you doing? What is your practice of how you take your signal? Do you confirm or do you not confirm? Because this is the topic that we're going to talk today. It's a strategy, but it's a strategy that suits most trading strategy, whether they are fundamental or technical. So let me hear from you whether you confirm or not to confirm, because every manner that you do would have a pros and cons. If you don't take a confirmation, you just take it off the signal, you're probably going to trade quite a lot, and a big portion, significant portion of your trades would probably go to stop out, but the ones that will work out will make you the hero of the day, right? You'll post it on your social, with your pal friends, everyone will clap on you, so you'll be the hero of the day. But the devastating part of it is that you're having a very poor success rate. And on the other side, if you confirm, you would have less trades that you're involved in. So that means a lot of trades that you're going to work on, invest your time, analyze, monitor, will go to the trash because you're not going to take them. And what's more devastating is you would see some good trades that you didn't take because the formation of the confirmation didn't work well. So before we can answer this dilemma, whether to confirm or not to confirm, let's involve some mathematics. Let's involve some numbers into this reasoning of answering this question. So what I've prepared here is something that I presented before many years ago, and I just love it. This table, you can create it yourself on an Excel sheet, and it calculates the break-even of your risk, reward, and the win rate that you need to achieve in order to create a break-even portfolio. A break-even portfolio means that you don't lose and you don't win. It's only a game it's only a mathematic that will help you to understand what kind of performance you need to practice in order to retain a break-even portfolio. So in order to be profitable, you need to be slightly above that, preferably much more than slightly. So let's just go over it. I did it on a sample of 40 pips per trade, per risk, per one. So if we are going to use, to be correct 50 times, 50% of the times, we'll be break even just by applying 1-to-1 risk ratio. If we are going to 1-to-2, we need to be correct only 33% of the time. If we're going to 1-to-3, we're going to need 25% and so forth. 1-to-4 is 20%, 1-to-5 is 16, 1-to-10 is 9%. It means that out of 10 trades, you need to be correct only once. So that's quite astonishing to understand that you don't need to have amazing success rate in order to achieve good break even or even more winning portfolio. So understanding this, we also have the opposite where you would be practicing a negative risk reward ratio, meaning that you're risking more than you're about to win. So let's say if you're risking 2 and aiming to win just half of what you're risking, you'll need to be correct 66% of the times. And 3-to-1 would be 75%. So what it tells us is that if we want to take a very low targets, it's probably going to be on a negative risk-reward ratio. And for that, we need to be accurate quite a lot. And if we want to take if we want to loosen the pressure of being accurate all of the time, we need to take a better preferred risk-reward ratio. So having said that, meaning that for higher accuracy, we need a lower risk-reward ratio. And for a lower accuracy, we need a higher risk-reward ratio. So that's to sum it up. What it means in order to answer the question whether to confirm or not to confirm is we need to see what side on the equation we want to be. What side on the equation our ability, our skills allow us to be. So the question is whether to confirm or not to confirm. And I will give you a spoiler. I am the person to say yes to confirm. Because with confirmation, I would stay out of the trading. I will trade much less. I will be less involved in actual positions. I will work much more on analysis, on monitoring, but I will not take all these trades because not all the time I'll get the confirmation formation to allow me to get in. But that will raise the accuracy level, and probably with that I'll be able to also create a preferred risk-reward ratio. So let's make a little pause here and let's talk about who I am. My name is Gil Ben-Hur. I'm the founder of The5ers. Today we run 4 brands, which is The5ers, which most of you are familiar with. Trade the Pool, we just launched this summer. Mickey, the guy before me, is the manager of Trade the Pool. We are also going to introduce Traders Day Live. It's the event that we're promoting here today that's going to be taking place in London this June, and you're all invited to meet us in person, see all these presentations in person. You can talk to us later on, set meetings, network with a lot of fellow traders. And we are also building up Trade Delicious, which Jordon, the first guy that was presenting here today, great Jordon from Australia, is leading. And Trade Delicious is a company that is a streaming channel that will do mostly what we do today, but on a daily basis, like every day. So my hobbies is I'm an enthusiastic tennis player, and I'm also a very serious photography amateur. Some of you probably know, but my background is art school, and so I'm always missing doing some art, so I'm practicing also photography in my spare time when I have some spare time. So let's go back. Let's talk about, so I told you that I am about confirming a trade. So what is confirming a trade? Confirming a trade is a price action structure, the way I see it. And that price action structure is what I use, is called Quasimodo. You can look it up in Google. There's some information about it. A lot of information in our blog, in our VOD library. And the Quasimodo is something that is very similar, looks like an head and shoulder structure, but it's slightly different. You would see that one shoulder is a little bit higher than the lower one. What it means is that it's not symmetrical. It's not a symmetrical pattern. And this is what makes the difference between Quasimodo and head and shoulder. This is the difference, but the big difference, because the lower shoulder, if we're talking about shorting, or the higher shoulder, if we're talking about longing, is actually a confirmation coming from the institutionals, from the professional traders, from the big shark players, that price should be going to that direction. So that is a confirmation coming up straight as a communication mean from the big money institutional traders. So that one price action, which is a very simple formation, and I will teach you today, is all about building risk. You would have your stop loss pretty much defined by this structure. You could also have your target pretty much defined, but that's more advanced stuff, so maybe we'll talk about this today, maybe not, but you can, like I said, you can, if you're interested, you can look at it, you can look at it later on in our VODs. So you're practically going to have a trading plan. It's an easy to master structure. It enforces trading discipline, and it will help you to know what you're looking for and know what you're waiting for, not being impulsive, not being vague, intuitive in your trading. After you master it, you'll have a better market understanding for where the turns, the turnaround, the reversal movements are happening. And it also talks the language of the buyers and the seller, the supply and the demand. We'll be mentioning a lot of supply and demand in this presentation because this is what I master, and this is what the basic reasoning behind that price action pattern. And once you'll have all of this, you'll be having more consistency. You will be able to hit more good trades in your portfolio, and that will make you more persistent in your activity. So you'll have better understanding, you'll have better discipline, it's easy to learn, you'll have embedded trading plan and predefined risk definition. So in order to learn it, it's simple, it's reasoned. I can explain it in terms of order flow, in terms of supply and demand, in terms of the power clashes between the buyers and sellers in the market. I can explain it by the terms of the big money players and market movers. it applies to stocks, the futures and Forex, whatever big liquidity assets that you can trade, you can use it as long as it creates valid price action, as long as those assets are not easily to manipulated by bigger players, then it's going to be better for you. It works on every time frame, from low to high, and I will show you some examples how we actually practicing it. Basically, we are going to toggle from high to low and from low to high time frames all of the time in order to see exactly what is happening, where are these pockets, where are these little key levels inside that Quasimodo price action. And because time frame is just an arbitrary unit, it doesn't, what really reflects and applies to the market is price and price levels. So it doesn't really matter what the time frame is. Time frame is just a representation of a series of pricing coming in. It suits variety of strategies. Most strategies that are technical, whether it's price strategies like Fibonacci, pivots, supply and demand, support and resistance, whatever it is, it works. If it's strategies like momentum, like Ruben mentioned, the volatility and Bollinger and moving averages, as Yaniv mentioned, all of these can work with the Quasimodo because it's all about price. When we see a resistance, when we see a support level, whatever it is, if we want, first we want to tell the market, show me that this level works. And once the way it shows that it works, it applies little Quasimodos in lower time frame, and that will be our clue that the resistance or the support is working, whatever it is, whether it's momentum or price based. So the Quasimodo work on every strategy. And like I mentioned before, it's a multi-time frame approach. I will show you how it's being done. So let's move on. So confirmation is about reversal. It's about where we want to enter, when is the market telling us that what we were thinking, what we were expecting is happening. And it's very easy to summarize this in one sentence. Every reversal begins with breaking a level. Every first time that we see a reaction on a level, we want to see the opposite level being broken. Even if we go to lower time frame, let's say price is hitting a demand on a H1, on an hourly chart, coming from 2 weeks ago or 2 months ago, it's hitting on a fresh demand. Now we want to see a reaction. We see a reaction. We want to see that this reaction is breaking some prior levels that were creating along the way, the downway to that demand. So once it's being broken, we have the first clues that price is about to reverse in some probability, not definite. And as a disclaimer for today, not everything works 100%. So we'll need to figure it out how to live with these numbers. But in general, every reversal begins with the breaking of a level. So this is what you need to look for. You stare at the charts, price is approaching your level, you want to enter, wait. Is it reacting? What does it mean reaction? The reaction means it will break a level. And let me show you. So I don't know how many of you are familiar with supply and demand. We have lots of information about this in our YouTube and in our VOD. So feel free to go there if you want to master this. But for me, supply and demand is what had changed, what made change in my trading. Once I understood what supply and demand are and what they're representing and how they can tell a story of the market, this is when the change was made for me. So just to give you a very brief presentation for those who don't understand what is supply and demand. Supply and demand are actually the swing lows and highs of the market. Okay? Don't take it as a word to word. It's where there are pockets of orders that weren't taken when the market decided to burst to one direction. I'll give you an example. So, you know what changes price is the equilibrium of traders, of buyers and sellers. If there are more sellers here, there are not enough buyers, price will go down. Okay, so let's imagine that there are 1,000 sellers and they want to sell 1,000 shares and there's only 500 buyers. Then 500 shares would be stay on the table and will not be executed. So price will go down until they find new buyers. What happened is right here on this place, we have 500 shares waiting to be executed once price returns back. Okay, same thing applies on the demand. There are 1,000 buyers, only 500 sellers, so price will go up. 500 will be left over on the table right here on the market. And once price come back, there are 500 orders waiting to be executed. So the supply and demand is actually the theory behind where we can see remaining pockets of orders ready to be executed later on in the market. So these are the places that will give us higher probability for reaction because there are simply orders in there that we know of that should be there. Of course, there are so many factors to validate or not to validate this, so you need to learn. But this is the very, very raw basic of supply and demand. I just went over a brief review for that, so we can proceed on. So let's get back to the confirmation. So when price is coming back to the demand zone, and I had analyzed this level and I'm waiting for many, many hours for that price to hit this level, I would want to see a confirmation. What would be the confirmation? Remember that statement before? This one? Every reversal begins with a breaking of a level. So, price hitting this level, I'm expecting for orders to be here and be executed. If there are buyers in here, the response of the price will be to go higher. So here's a little level created just prior for hitting that demand zone. So that is the first level broken, and it signals me, it gives me the first clue that if this was a seller's market, now buyers are gaining power. They are gaining more and more shares. They are buying, they are joining the game now, and the sellers probably got a little bit tired. So it's just the first clue. And this is the confirmation we're looking for. We want to see a little level being broken. And that would be the first thing. Same thing applies on the top. For supply, price is, we were rating, monitoring this level. We're assuming that we have some orders waiting here. We're not sure. We want to see how the markets react to this level. And if we see that price is breaking a tiny level before that, then we know that sellers are joining in the market. And that would be our first clue for that zone to be active and reacting to what we're expecting. So now let's move deeper into what is the Quasimodo, how it looks like, what is its anatomy, how it's being made of. So I've created two charts, one for selling, one for buying. For some reason, I don't know why, many people are more comfortable looking at Quasimodo or head and shoulder in for short structure. So here's the sell, here's the buy confirmation. So we see price is coming up, approaching to a level, making a higher high, making a lower low, passing that. So until here, the story was that the buyers were on the upper hand. They were buying, some retracement, which is logical, right? This is how the market goes. And then it's coming up and hitting a higher level. But then that higher level, for some reason, made the buyers weaker, and some stronger sellers came into the market and actually made a significance. They had broken that low, creating a lower low. Same thing for the buying confirmation. Price was coming from above. Sellers were on the upper hand, making a low, making a high, a retracement, and then hitting a lower low. And then the reaction of that lower low level was breaking the last high, which tells us that there are buyers piling up, building up some strength. So the Quasimodo, like I told you, it's very similar in its shape, formation, to head and shoulder, but it's not very much head or shoulder. So we are marking, in order to sell, we are marking the low shoulder, the low left shoulder. And for the buy, we would be marking the high shoulder. And we want to see price had breached that level on a very horizontal line. No diagonal line, no trend lines, very straight, because price is price. If there were leftover orders on price 1.005, the orders stays on 1.005. Okay, so there's no diagonals here. It's purely order flow reasoning, and this is why we're talking about horizontal lines. Okay, so for short, we are marking the low before hitting that high level, and for long, we're looking for the last swing high before the reaction. And we want to see price breaching those levels. If they did, then we want to take the left shoulder as the entry point. Okay, left shoulder for buying, and left shoulder for selling. Okay, so the sell will be, if we were making a lower low, we would be selling from the left shoulder. If we were looking to buy sorry, the high shoulder. If you want to buy, we're going to buy from the low last swing before it was broken the high swing. Okay, and from that we would buy and we would sell, and this would be a successful Quasimodo formation, and this would be the way that we confirm. So basically we have 4 lines before we actually make the confirmation. We have the confirmation already done when we were breaching the low after making a higher high. Okay, so this is what matters, the reaction from here to here, breaching the lower swing on a buy, when the reaction from the lower demand that had broken the high that was made from the last low swing, that would be our confirmation structure. And then from now we are just brainless trading in. The signal now would be entering right off that line with no brainer. Just when we have this price in, punch in and get in. That would be the way that you do. Okay? The risk definition, like I told you, it's going to be very, very easy, and also no discretion here. You would put your stop loss just above the swing high if it's for the sell, or the swing low. So that will define the unit that you're risking in that trade. From your entry to the swing low on a buy, from the entry to the swing high. Okay, so let's wrap it up before we do some examples. So with the if and then equation, if price action is lower low, then sell on the high swing. If for buy, if price action is bigger than the high swing, then sell the low. That easy. So let's see some example of how it looks on the charts, which is very, very okay. So price is coming from below, hitting a level that was created back in history on the left, reacting to that level, creating the significance, breaking that lower swing level. Where we want to enter? Right here. Where is our stop loss? Right above the swing. So that is our stop loss. Entry is right here. We have entered. We have few pips in drawdown, and then we have the full swing. If I'm looking at this right, it's about 1-to-6, 1-to-7 risk-reward ratio. Then price is coming back. A level was created here, a key level. Price made a last swing, reacted to that key level, made a significance by breaching that lower swing. So where we want to enter? Right here. This will be the definition of our risk. Stop loss will be above the swing, and we'll get all the way down. Some pips will be drawdown, very, very quick, will be on the green pip area. So like I told you, I have many, many examples how this can apply to many, many different type of strategies. So with supply and demand, here's a supply, here price coming to supply, creating a significant low. So we would want to enter right here. Okay, that's an S&P, very previous, it's almost real time what we see here. So we could have sold here, and that would be a reaction that we'll see in the next hours or days, how it reacts. We see price coming back to fresh supply, creating significant by breaching, passing the lower swing, and that would be our entry on the left shoulder. Okay, same thing on Euro Yen. We have fresh demand, never touched. We have high swing coming in, reaction on the fresh supply, creating significance, making a result, breaking that level. Remember, every time, every swing, every reversal start with breaking a level. So here's the breaker, the level that was broken. We will be entering on the left shoulder, buying, and from that we have a very good potential. I see about 1-to-6, 1-to-8 risk-reward ratio. So I will run over this very, very quick. The time frame consideration, there's no time frame for price. Price action is price action. Where price decided to stop, where price decided to retrace, where price decided to break, this is where pockets of orders are left for you to be used. And the Quasimodo or the price action would be applied to price levels rather than time frames. So what it means is that when we are analyzing our charts, we need to analyze it looking at multi-time frames, because sometimes we see events that are hidden in lower time frames that we can't see on a higher time frame. It's never a singular time frame to analyze. We always want to see the full picture. Remember, time frame is just a container for aggregating price, giving you only 4 matrices: open, close, high, and low. So if you want to see better resolution, you need to go down there, because what drives the market is price and price levels. Okay? Risk management is, like we said, you need to decide how much you want to risk, and you need to see it according to the way that you are mastering this, and what kind of performance and risk and success rate you are able to create using this. By that, you will create your risk, but you have the risk definition already in by knowing that you're going to cap on the last swing. And lastly, to have a better odds for success, you need to be in line with the market context. It means that you need to trade in wisely and trade with the trend in order for that to be more effective, or trade only on the fresh levels, or only on the very, very tops and bottoms, not in the middle, because if you look on the formation that we've just drawn here, you will find them everywhere. But the probability for them to be successful will be less, and so you need to be very much aware of the context of the market direction in order to increase your odds for success in this. So let's see how we can use it. We can use it on a pullbacks. We have price coming down, creating a pullback. The pullback is being held by a supply and a key level coming right from here. We have a higher, this create a reaction that breach the lower swing. So we will wait for price, and it's coming right a candle, one candle after, and we're in, and we get 512 pips potential. Okay, I'm not saying that we know how to take it out. We know because we have this demand, but we could take this one. It really depends on the personality of trader you are. But the potential was 512 pips while risking, let's say, 30. You do the math. Same thing, price coming up. Now we have this swing high. The context is that price is pulling back and market is going down. So we're in the context, reaction on the key level, and we're making significance on that reaction. So that's a no-brainer for us to enter. Our stop loss is just above the swing, so we're safe with that trade, and we can go all the way down. So that's on a pullback. We can also do it on a key levels. Here's a key level made 3 months ago, and price is coming down, reacting, creating significant breaching off the top. You see how easy it is, how simple method it is? Every reversal begins with breaking a level. So the last swing that brought us to the key level and the significant reaction, this is our signal. From now on, we're just waiting for price to return back to the left shoulder. We're in. Okay, that's a key level. Another key level made from on gold. H1. Here's where we going to, when price is coming over here, now we're looking for how to, for the Quasimodo to form itself. So let's drill down. We're on H4 key level. Now we're expecting it for many, many weeks. Now it's time for us to drill down to lower time frame. And we see that the reaction on the key level right here, creating the Quasimodo. So next time we would want to buy the left shoulder. On Fibonacci. Okay, Fibonacci, same thing. So we have Fibonacci drawn from low to top on that swing. Now we'll be somewhere applying on these. So on the 23.6 level, we see price. We expect some reaction. We don't get it at first. We don't have any confirmation here. But suddenly, we have a confirmation around that level. We have that Quasimodo. We have a lower low. We have a swing breaching. We have our entry, and we get our trade in. Okay? So that is the outcome. The outcome on the S&P was plus 5% gain on the price, 1-to-1. Okay? Same thing on trend lines. We see a trend line, and this is an example for you that how Quasimodo would save you from taking the wrong trades. Okay? Price is hitting the trend line, and most trend line traders would be taking this line and say, okay, I'll hope that it worked. But if we wait for confirmation and we don't get the formation that we need, we're out of the trade. We're not taking it. So we were saved. Okay? But here's how it should be looking when it's going to work on a trend line. So we have that trend line respected. Okay? So this is the trend line. We see a Quasimodo forming. Now all we need to do is wait for that line to hit. We're in with fraction of a pip with a big reaction in on a trend line. Okay, so what I'm trying to say here is that if you apply the right measures on the Quasimodo, on the confirmation, you would be saved by sabotaging your hard work. You can stay out from not taking the right trades. You can be taking only the trades. And remember that table in the beginning of the presentation of the risk to reward break-even tables. If you want, you can write us and we can send you this calculation, or you can build it yourself on Excel. It's very simple. You would know that's what you want to achieve in your portfolio. So I would say we better confirm our trades to increase our odds to have a successful portfolio existence. So let's wrap up. Confirmation by Quasimodo. It's a multi-time frame. It works on every time frame, and we need to drill down in and out on a time frame. It's going to help us to avoid disasters, not taking the right trades, because we don't see the confirmation, we're not in, we're not being stopped out. We need to have it aligned with the market context. It's easy to learn. This is how professional price action technicians are trading. It will help you to create a preferred win rate and a preferred risk to reward ratio. And it also structure for you the risk management, where you place your stops. Where you place your TP is a whole different story, needs to be discussed by, mostly considered by the trading strategy that you're actually doing. Okay, so that was an overview about the Quasimodo as a price confirmation price action. On June, we're going to be in London. All of us, all the people that you've seen here and many, many more. If you go to our webpage, you see the lineup with all the speakers that are going to be here. It's going to be very interesting. It's going to be a wonderful networking event in London, in the center of wherever comfortable for everyone to show up, from Europe, from the US, from Asia. We already have hundreds of people sign up for this event, and we're still expecting many, many more to come. It's going to be a unique event that never been seen, only dedicated for trading education, for being better traders, and for networking about trading. It's not about commercial or any stuff that people would want to sell you. Of course, we're going to have some sponsors, but that's just to pay off for this luxury. Anyway, on Traders Day Live, we'll see you in June. I really much enjoyed it. Thank you. And Michael,
Amazing.
join me.
Amazing. Yeah.
Thank you.
I always like to hear you talking about supply. It was amazing, Gil. I always like hearing you talking about supply and demand. So thanks so much for that.
Thank you.
Yeah, appreciate it. And of course, we have a lot of guys typing a lot of questions in the chat box. So let me tackle you with that. And you know what? I got a special one, and I will leave it to the end. First, let's talk about supply and demand when it comes to valid the area, right? A lot of people are asking basically, how do you know that this is the right area when from there the price won't continue to the downside or won't breach it to the upside and sort of?
I love this question because my approach to trading is that I know nothing. I think people that trying to predict the market are having the wrong approach in trading.
Yeah.
And so whatever we need to do is we need to apply our assumption and understanding, making it logic to us, learn it, backtest it, gain experience, and then never try to jump over and think that you know everything. Right. Let the market show you. So we will, there are ways to make the perfect, so-called perfect lines for supply and demand, but it doesn't really matter because sometimes price would breach it, penetrate those zones. So you can drill down and you can find a better levels inside it. So it's all about the practice, but regardless the practice, let the market show you that this level is reactive.
Right.
And this is what we were talking about today. We just wait for the confirmation. We see the price action applying on that level, and then we're happy. So we know nothing. Let the market tell you.
Okay, that sounds good. What about, let's talk about the Quasimodo. What time frame will be the right for it? And do you have like, is it a bigger time frame will be more reliable than the shorter time frame, those kind of stuff?
I think I mentioned this a few times in the presentation. There's no time frame. Time frame is just a unit accumulating aggregating all the pricing coming in that unit of time. So we need to run through all the time frames all of the time, in and out, and see where we see those price packets, where we see those levels making sense. And this what would be good, because price would be reactive to price levels from whatever they were created from.
Right.
So we'll know that price will go and drill in and out on the time frame until we see something clear, and that will be helpful. But I have this thumb rule. Let's say I'm analyzing. I like to analyze from higher time frame to lower time frame. So I'll start with the daily, sometimes weekly, daily H4, H1, and then when I see and I love the H1 and up levels,
Right.
Because the H1 are providing a lot of signals that I can use in a day trading. But then I would drill down to lower time frames. So my thumb of rule is to look for the signals 3 times time frame levels below. So let's say if it's 1 hour, I would go 30, 15, 5.
Okay.
Okay, and sometimes I would go even to 1. If it's H4, I would go to M15.
Right.
If it's daily, I would go to H1,
4,
M30, like that. So, but it's just a thumb rule, just to help me to navigate through. But I would always continue to look for what makes sense in terms of price action.
Right.
So I will drill down until I get it.
And when it comes to taking profit, let's say you enter the Quasimodo at that specific level, you saw the supply or demand, where are you aiming to take at least your first partial out?
It really depends on the strategy that you analyze with. If you analyze key levels, if you analyze Fibonacci, if you analyze anything else, you probably have the estimation of where price you want that to go. And that confirmation will just give you the clue that your assumption is about to happen on a bigger potential, on a bigger probability.
Right.
So it really depends on your strategy. If you want to go pure on supply and demand method,
yeah.
you would go to the first swing. Let me just find a quick chart. So if we have a supply and demand right here, I would try to take the first TP around this swing, because I don't know if that will breach this level.
Right.
But we already seen this. I can take this one. I can take this one. So it really depends on your appetite, your expertise, the way that you've backtest. It's really, so this is why I mentioned that the TP is a very complex thing. It's really depends on other considerations.
Right. Okay, so I guess the okay, someone is asking how much to risk per trade. Let's maybe touch that. Generally speaking, maybe not even specifically for
generally
Quasimodo.
speaking, I think 0.5% of the account would be the most to risk. Other than that, if you like higher, it really depends on how you measure your performance. You need to trade, and you need to measure the outcome of, let's say, 100 or 200 trades, and take out your statistics and see what makes sense for you. So don't take just a broad number, or anyone telling you 2% or 1% or whatever. Just measure your backtesting, and based on that, make something that you're comfortable with.
Yeah, because at the end, as we all know here, the trading is super individual, right?
Yeah.
I mean,
exactly.
you can trade one thing, I can trade another thing. just personality, the time that you put in, all of those kind of elements.
Exactly.
So yeah. So I'll finish just before we'll go to the raffle. The question for the raffle, I'll finish with an interesting one. What inspired you to start the 5ers? Yeah. But we only got 2 minutes.
It's
okay?
a very long story.
Yeah, I know. We got 2 minutes.
Well, I was a trader. I came to the point that I'm successful, but I didn't have enough funding. I was looking for a job. It was very hard to find one. The online working space was already occupied by many other professions, but not in trading. Nobody wanted to hire a professional trader. I used to be a private portfolio manager, but it was very hard to maintain clients for a long time, and I wasn't really focused on this. So I went to look for. I wanted a solution that will help you to work online, and that is part one of this. The other part is that I was part of a very prosperous group of traders, and we decided that we want to trade together. I've created the whole structure of how we can trade in one pool together, and we met and we decided how we're going to do it, and eventually, and everyone were very excited. Once we started trading, very quickly the discipline wasn't there, and people weren't showing up to work, and it's just gone. And I said to myself that everything that I've built, I want it to be out there. I'm not losing it. So I took those two motivations, combined them together, and the 5ers was created.
That's amazing, and thanks for that. Okay, guys, so we reached the moment of truth. Gil is gonna ask you the question. In order to get into the raffle, you just need to click on the link that we just shared in the chat box. As soon as you do that, answer the question. If you get it correctly, you will be in the raffle. Again, let me remind you, the prices are incredible. We're talking about 6 tickets to our live event in UK in the upcoming summer, and also 12 evaluation accounts to trade on our capital. So Gil, please, what is your question?
So my question is, where you do not take Quasimodo, where you do not confirm a trade?
Nice one, yeah. Okay, guys, so we are wrapping up this incredible event that we just had, 6 hours. Of course, go ahead and watch it at least 2 more times. You know, go back all the way to Jordon presentation, then Ruben, Yaniv, Saul, myself, Gil. Take all this information, all the trading content that we delivered today. If you have any questions, of course, continue to write them in the chat box and we will answer it later on. You can send us questions through help@the5ers.com and take advantage of maybe the Christmas deal that we are having in the 5ers and in TTP. And check out our tradersday.live website to get into the UK event that we will host very soon, 6 months from now, in London, UK. It's going to be a blast. We're going to learn a lot of things and then going to grab a beer together and talk about trading and whatnot. So guys, thanks so much for being with us this whole 6 hours, and hopefully we will see you with us trading. Thanks, Gil.
Thank you.
Alrighty. Take care, guys.